Well, turning to the U.S. economy, our first speaker is Nigel Galt. He's the chief U.S. economist with IHS Global Insight. Nigel is widely quoted in the Wall Street Journal, and I think you'll find his observations today very informative given where we are in the national economy. Please welcome Nigel to Morgantown.
Thank you very much for inviting me back here again to talk to you. As I've gone around the country over the past 6 months or so addressing audiences about the state of the U.S. economy, I guess I've been impressed by the optimism of the people I've addressed. They always want to know, come to me say, have you got any good news for us? I mean, they really want to hear good news. And it's from somebody who comes from Britain, that makes quite a contrast, because the British are a fairly pessimistic bunch. And in an economy like this, most people in Britain would be coming up to me and saying, oh, it's terrible, isn't it? It's a disaster. We're never going to come out of this. But people here, they're optimistic. They want to hear good news. Unfortunately, up to now, I had to say, no, I'm afraid it's getting worse, and it's probably getting worse at an accelerating rate. What I can say to you today is that there is a little bit of good news that I have for you. I mean, I will be realistic. I've got to try to strike a balance. There's plenty of bad news out there, and there's plenty of problems still to come. But we can just now start to see a few indications coming through that at least the steepest rate of decline in the economy is behind us. And there is now realistic hope that sometime in the second half of the year, the economy is likely to bottom out. It'll take longer for the labor market to bottom out than for output to bottom out, because the labor market generally is a lagging indicator. So unfortunately, the labor market's probably going to get worse even as we go into 2010. But there's realistic hope that we'll start growing again in year 2010 and have a more robust recovery in 2011. So it's getting to a slightly more mixed picture. Now that said, let's get a lot of the bad news out of the way. Turn this on. I mean, we are facing, both in the US and globally, the worst recession in the post-war era. It may be the biggest global housing and credit bubble, and I'm emphasizing global here because the US housing market, the US subprime market, was probably the most extreme case of excess, but it was only one among many housing bubbles around the world. There were housing bubbles in the UK, there was a housing bubble in Ireland, there's a housing bubble in Spain, housing bubble even in Australia. And what has happened is that as this global bubble has burst, the recession has been global. And what's been interesting is even countries that thought they were immune, that thought they were being very responsible in their lending, have been hit extremely hard by the downturn. The notion was put forward for a while that maybe the rest of the world could somehow decouple from the US economy, and that even if the US housing market went down and the US housing market went down, the rest of the world would stay resilient. That has proved to be wrong. That hasn't occurred, as I'll show you in a moment. Many parts of the rest of the world have been hit much harder than the US. Now, there are some strong forces helping to support growth or helping to dampen the extent of the downturn. Lower oil prices have given us a cushion. I'll illustrate the magnitude of that later. The Fed, as I put it, has all guns blazing. It really has tried everything that it can think of to try to support the economy. It's of course cut its short-term interest rate effectively to zero. It is out there in the markets. It is effectively it's lending to support purchases of commercial paper. It is buying up mortgage paper, and it is now buying long-term government treasury securities, trying to force down long-term interest rates. And it's essentially printing money to do all of this. A practice which in normal circumstances would be irresponsible and viewed as likely to cause inflation, but in present circumstances is what the Fed has to do in order to try to prevent an even steeper downturn in the economy. Major fiscal stimulus is coming. I'll give you an idea of how much help I think that can give to the economy. We haven't yet, I believe, fixed the banking sector. We are getting somewhat better news coming through on bank earnings, but I suspect that before we're done, there's going to have to be some bigger injections of government capital into the banks than we've seen so far, which does pose a problem for the administration because it's probably going to have to go to Congress at some point for extra funds to inject into the banks. And Congress at the moment is quite hostile to giving more money to the administration. And we are, bottom line, facing the worst global recession in the post-war era. But as I mentioned, we're not the worst hit economy in this. The chart here shows you fourth quarter GDP changes. So it's fourth quarter compared to third quarter at an annualized rate for major economies around the world. And the US declined, we declined at 6.3%. That's the official figure now. The UK, another economy which had a housing bubble which is probably even more extreme than the US bubble, also declined around 6%. But take a look at some of the other economies here. We have Germany down 8% annualized rate. Japan down 12%. Singapore down around 17%. And Korea down almost 20%. So these are huge declines. And I guess you can think of the US and the UK to some extent as being, or as having been, the big spenders in the global economy. The economy is very strong residential investment, very strong consumer spending, pulling in a lot of imports, and helping to drive a lot of the rest of the world, which was really dependent very much on exports. Germany, a major exporter of capital goods, and all of the Asian economies, big exporters, not just of capital goods, but also of consumer goods. So what has happened is global trade has collapsed. And the economies that were most dependent on global trade, most dependent on exports to drive their economies, have been hit even harder than the economies who were responsible for those exports, who was buying those exports, the consumers. So that emphasizes the extent of the pain globally, and also I think it emphasizes that we can't look to the rest of the world to be pulling us out of this downturn. In fact, the rest of the world is still looking to the US, and to some extent to China, to pull it out. So they're looking to the US to pull out first. We're not going to be bailed out of this by exports. The summary picture for us, if you look at where we see real GDP and industrial production heading, this is for the US, is that this year we think GDP probably a decline of more than 3%, which would be by a long way the worst post-war year. 1982 was the worst, minus 1.9. That's the worst so far. And industrial production down around 10%. Although I would emphasize that most of that decline in industrial production has already happened. It happened in the fourth quarter of last year, and it happened in the first quarter of this year. As we move forward, we see a modest recovery in 2010. We've got US growth of 1.4%, and then further momentum in 2010. We're up to around 3.5%. The problem for the labor market is that this is such a deep downturn that it's going to take many years of growth to actually remove the slack that is presently emerging in the labor market. So unfortunately, the unemployment rate, which will probably hit 10% before we're done, is going to be quite slow. It's going to be quite slow to come down. And looking at this recession in the context of previous post-war recessions, the chart emphasizes that in terms of the peak to trough decline in GDP, this, we believe, will be quite easily the most severe post-war recession, a peak to trough decline of over 4%. We got used to mild recessions. The 1990-91 recession, 2001 recession, in terms of GDP, were very mild. this recession, we haven't seen if you like, a balance sheet recession or a recession linked to a financial crisis like this one. We haven't seen a recession of this type really since the Great Depression. So I don't want to imply by any means that this is the Great Depression, but in terms of the type of the downturn that this is, it is more similar to that than to the cycles that we're used to in the post-war period. Now, in the financial crisis, where do we stand? There's some positive signals there, and there's still some clear problems remaining. Positive signal: banks are much more eager or willing to lend to each other now than they were several months ago. This chart here shows you something called the TED spread, which is it's the difference between the rate of interest at which banks will lend to each other and the rate at which they will lend to the government. So it's the difference between the interbank lending rate and the Treasury bill rate. In periods of crisis, when people are worried about banks failing, when banks are worried that if they lend to another bank, they won't get their money back, that interest rate spread can spike. And it did spike massively back last August, September, during the most extreme part of the financial crisis. You can see, historically, if you go back to the period before we started to get into trouble in the middle of 2007, that spread usually used to run around 50 basis points. The spread's now come down a long way, indicating reduction in fear in the markets. To some extent, I think that reflects a belief that after the Lehman Brothers episode, because when Lehman was allowed to go under, that was incredibly disruptive for the financial markets, that no other major financial institution is actually going to be allowed to collapse. There may possibly be some institutions that get nationalized, possibly could get taken over by the government, but they're not going to collapse. So people are less fearful. Banks are less fearful about lending to each other right now. Another measure of risk here, this is in the commercial paper market, the market where companies can raise short-term funds. And it's the spread between the interest rate on low-quality commercial paper and high-quality commercial paper. And in the crisis, particularly after Lehman Brothers went under last year, that spread just exploded, indicating essentially people were fleeing from risk. So nobody was prepared to touch low-quality commercial paper, and that interest rate spiked. The Fed has taken a lot of action to support the commercial paper market, and that really has paid dividends. The spread there has come down dramatically. Again, an indication there's less fear in the financial markets. Not all the signals have improved. If you look at the long-term bond market, the chart here illustrates the spread between long-term corporate bond yields and long-term treasury yields. Both of these spreads, one looks at AAA credits and one looks at BAA. These are both investment grade types of paper. We're not looking at junk bonds here. But this chart goes back to 1962, so it goes back a long, long way. So you can see what historically has been normal. And the spread on the lower quality paper, the BAA quality paper, is still extremely high, between 5 and 6 percentage points. And the spread on the AAA paper is still high relative to norms in that particular market. That's still near 3 percentage points. So the corporate bond market is clearly not back to normal. That investors in this market are still extremely reluctant to take on risk. One area where there's clearly good news in the mortgage market, mortgage rates have fallen. The chart here shows you the 30-year fixed mortgage rate. This is a short period of history back to 2008, just to highlight the recent decline. We have 30-year mortgage rates that have now dropped down below 5%. And there are really two things that have driven this. The Fed has actually been buying up high-quality mortgage-backed securities. That has helped. And the Fed is also directly buying long-term government treasuries. And to the extent that it drives down the yield on treasuries, that does tend to pull down the whole of the interest rate, all of the interest rates at the long end. So if you pull down the treasuries, you tend also to pull down the yield long-term mortgages, whose yield is linked to the treasuries. So we've got mortgage rates down below 5%. That sparked a wave of refinancing. It sparked some improvement in purchases, very tentative at the moment, and what we need to really watch, one thing to watch over the next few months is whether there is a sustained pickup in mortgage borrowing for house purchases, because a temporary boom in refinancing, that's not going to pull the economy out of this recession. But a sustained upturn in mortgage borrowing for purchases, that'll be very important for home sales and for housing starts. But credit conditions are still overall extremely tight, and of course, to benefit from those low mortgage rates, you have to have a pretty good credit rating to start with, and have some. If you're an existing refinancer, you have to have some equity in your home to be able to benefit. For most households, credit conditions are still pretty tight, and if you look at the top two charts, it shows you what's happening to growth in consumer credit on the left scale, and growth in home mortgage credit. That's on the right chart at the top. And consumer credit growth on the left, that is slowed dramatically over the course of 2008, so that right now consumer credit growth is only just above zero year over year. It's just 1% year over year growth. And home mortgage credit, that's now in negative territory. So the amount of home mortgage credit out there is actually contracting. A massive contrast to the boom a few years ago, where people were borrowing to the hilt against the value of their homes in order to finance maybe renovations, perhaps consumer spending. People are now, on net, we're actually now paying off mortgage credit rather than taking on more debt. And the proportion of banks who say that they're tightening credit standards, whether it's for consumer loans, which is in the bottom left-hand chart, or whether it's for mortgage credit on the right-hand chart, the proportion tightening credit standards, that's still pretty high. So credit's still very tight. Now, what's the latest evidence on the recession? And here, I can show you a few of the glimmers of hope that are starting to come through in the data. And this chart, it's got one more data point in the top left chart than in your handout, because we got a new retail sales number this week. So top left, retail sales excluding autos and gasoline. Exclude those autos, autos can be volatile, and gasoline can move just according to the latest move in prices. So this is better indication of underlying trend. January and February, we had 2 months of pretty solid improvement in retail sales, after a series of months in the second half of the year when all we saw was negatives. Now, bit of a damper this week. March sales were down, but that didn't actually remove the good news completely, because we still have a first quarter overall that's substantially better than the fourth quarter. And if we look back to the second half of last year, consumer spending was falling at about a 4% annual rate in both the third quarter and the fourth quarter. Based on all the news on the consumer that we've got for the first quarter of this year, we think spending grew 1.3%. Now, 1.3% normally would be nothing to write home about, but plus 1.3 is an awful lot better than -4. So there are some signals of stabilization for the consumer. Over on the right, housing starts. We actually saw an uptick in housing starts in February. For the first month in a long time, it was an uptick of about a bit over 20%. We got the March housing starts number this morning, which is too late for me to put in this chart. We lost some of that. It went down by about 10 or 11%. So we lost some of the improvement. We're not all the way back down to the January number, though. And I think a lot of these month-to-month movements have been essentially generated by fluctuations in the weather. But if you take the last 3 or 4 months together, we're starting to get an indication of maybe housing starts are actually bottoming out at an exceptionally low level, I would add. I mean, 500,000 annual rate of housing starts would have been unthinkable a couple of years ago, because we haven't been below 1 million since 1946. So 500,000, is half the level that would have been considered as unthinkably low. So it's a very low point, but it looks like we are starting to bottom out there. bottom two charts look at the manufacturing sector, and actually note that the chart on the right is a different one from the one that I put in your handout, because based on the evidence for this one, I wanted to make an important point, so I've replaced the bottom right-hand chart. The ISM Manufacturing Index is, of course, a leading indicator of growth in the manufacturing sector. It's a diffusion index where 50 means flat, no growth, no decline. Below 50 means we're declining, above 50 means we're growing. So around August time last year, like many other indicators, the ISM Manufacturing Index on the left essentially went off a cliff. But it looks like we probably hit bottom on this index in around December. And the last 2 to 3 indications, the one we've got for the first 3 months of this year, we're hovering just above the 35 mark. Again, historically exceptionally low, but a lot better than we were. And the early indications from regional surveys for April is that there will probably be a further improvement this month. Chart on the right, ISM manufacturing orders. It's one of the components of the index on the left, but I'm focusing it because orders are clearly something that tell you something about where production is going to go in the future. That orders index fell almost as low as 20 at the trough. That was actually the lowest reading in the entire history of this series, which goes back to 1948. So it shows you how dramatically orders were plunging. But we've seen a fairly clear improvement in that index over the past couple of months. And in the last survey, it popped up to just over 40. Now that still says that orders are declining, but declining much more steeply than a couple of months ago. And clearly, we need to walk here before we run, and the first stage towards getting to recovery is seeing the rate of decline slowing. And that's what we appear to be seeing in these orders numbers. So that really, to me, is a signal that the headlong decline in manufacturing, which really extended all the way through March, certainly in the production numbers, that's starting to come to an end. The place where there's still a lot of bad news and will be bad news for a long time to come, though, is the labor market. The chart shows you the monthly changes in total payroll employment. And for the last several months, we've been in the 600,000 to 750,000 region every month. And this string of declines is unprecedented in the post-war era, to have so many huge declines for so many months. Labor market does tend to lag behind to some extent what happens in production. It's not easy for companies to suddenly adjust payrolls to a much lower rate of sales that they're perceiving. We believe that the worst declines are now in the past, and that as the further we go into the year, the smaller those declines in employment will be, and then we get into 2010, we're going to start to see some increases in employment. But I think we do have to expect that the employment numbers are likely to decline throughout the rest of 2009. But the important thing will be at a diminishing pace. One key issue that is holding us back right now, and which is an extreme drag on the economy, I think, and will be so, I think, for the first half of the year, is that we've got a huge overhang of unsold inventories to work off. The chart shows you the ratio for the whole economy, so it's manufacturing, wholesale trade, retail trade, of the stock of inventories to the rate of sales. So it's the inventory sales ratio. So essentially, it's the number of months' worth of sales that companies have on hand in inventory. The chart goes back to 93. You can see historically, as companies have been able to manage their inventories better, that there's a trend, there's a downward trend in that ratio. Companies have become leaner, don't have to hold so many inventories as they did in the past. Late last year, fourth quarter in particular, as sales collapsed, the ratio of inventories to sales surged higher. Essentially, we wiped out all of the decline in that index that we'd had since around 2001. We wiped all of that out, just over two to 3 months. So that leaves companies with excess inventories on hand. As a result, they don't need to produce as much. They don't need to order so much from their suppliers. And that low level of production and orders remains until they've got their inventories under better control. The chart I've shown there, it's got one more month than the chart in your handout. It now goes through February. And I think you can just see in the chart that February is lower than January. So that indicates that we're just starting to make some progress in getting that ratio of inventory to sales down. As long as we're doing it, working off these inventories is going to be a huge drag on production. But we're going to have to do it in order to set the stage for future growth. And as you can see from the chart and from the progress we've made so far, there's a long way to go. And it's because of the inventory cycle that we think that the first quarter GDP picture is actually going to be a bit worse than the fourth quarter. The fourth quarter decline in GDP, 6.3% annualized. These are quarter-to-quarter growth rates annualized. We think the first quarter decline will be between 6.5% and 7%. But something like 2.5 percentage points of that decline, of that 2.5 percentage points out of that 6.5, we think will come from inventory adjustment, from a huge rundown in inventories. So you can view that as being, it's a temporary drag, it's severe, but it's a necessary adjustment in order to set the stage for future improvement. As we go further into the year, we see the rate of decline of output at first slowing down. Then by the time we get to the fourth quarter, we think we'll be growing, not dramatically, but a small positive growth rate. And then we see the recovery gathering more momentum as we go into 2010 and 2011. So in the sense of, if we're asking ourselves, is the worst past? I think the worst in the sense of the most extreme declines in output, in terms of the rate of decline, I think that is past. I think that was the fourth quarter and the first quarter. And the first step moving forward will be for the rate of decline to slow, and then by the end of the year, we'll probably be looking at actual growth. You have in your handout the summary numbers for growth for GDP and key indicators year by year. I'm not going to go through all these numbers. I've got a number of other charts which will look at details. But as I mentioned before, this year GDP we think down 3.5%, with almost all major categories of spending showing steep declines. In terms of the change, in terms of things that are looking much worse this year than last year, I think the biggest changes are in some change for the consumer, but the consumer was very soft last year, so the consumer is actually declining this year. It's business investment. Business investment down almost 20% this year. It was up a little bit last year. But probably the most extreme, exports. Exports down 15% this year after an increase of 6% last year. So that's why I wanted to make the point at the beginning of the talk about what was happening in the foreign economies, to emphasize what a difference that has made to our outlook. Exports were supporting US growth. That's no longer the case. Other key indicators, industrial production, as I said, down about 10% this year. Unemployment rate, averaging, we fear 10.2% next year, probably peaking out. Probably the peak is the first half of next year. And then we start a gradual decline. But we're still, even in 2011, we're still quite close to 10%. This is going to be, we believe, a very long process to get that unemployment rate down to rates that we would regard as being acceptable, which will probably be in the 5 to 6%. Oil prices we see gradually edging higher. $45 this year, $54.61 as global growth starts to recover. But note the CPI inflation. CPI negative 1.4% this year. That's not the same thing as deflation. Deflation is a continuing process, a decline in the CPI headline, the decline in the CPI core, a decline in wages, everything declining steadily. That's not the same thing as happening here with the CPI. We have minus 1.4, because of the next line, because of what happened to oil prices. Because for the rest of this year, we're going to be comparing gasoline prices with their peak levels of last year, and that's going to mean the CPI is going to stay in negative territory. Federal funds rate, the Fed keeps interest rates near zero for all of this year and for most of next year. In turn, that helps to keep long-term government bond yields low. And the dollar peaking this year, we believe, that's an index there, indexed to 2000, so it's a level, it's not a rate of change. The dollar's moved up because people essentially have fled from risk, so they viewed the dollar as somewhat of a safe haven, so the dollar has strengthened. Over the next couple of years, we see the dollar going down again as people become a bit more confident in the global economy, that they'll start to look more at fundamentals, and the US fundamentally still has big issues. There's still going to be a large current account deficit. There are going to be a huge government deficits that will need financing. We think that'll probably mean that longer term, the dollar has to go down. Fiscal stimulus, that's in our baseline, so that prevents a worse outlook. And let's take a look at what that's doing. The headline number that you will have read about is $787 billion of stimulus. You have to bear in mind a couple of things. Firstly, that's over 10 years, so that doesn't all come in at once. And secondly, 70 billion of that fiscal stimulus comes from extending relief from the alternative minimum tax for another year. So preventing the alternative minimum tax from kicking in. We don't regard that as a stimulus because I don't think anybody ever believed that the alternative minimum tax was going to be allowed to kick in and give people a $70 billion tax bill that they would have to pay up next April. So we don't regard promising people that you're not going to raise a tax which nobody thought was going to be raised in the first place. That's not stimulus. So the stimulus effectively is $717 billion. But how much of it comes through early? That's what really is going to help us now. We think 561 billion of that comes through in calendar 2009 and calendar 2010. And most of it in the early stages is in personal tax cuts. I put tax cuts in quotation marks because some of the tax cuts are for people who don't pay taxes, so those are actually transfer payments. Other personal transfers to people hit by the recession, such as extended unemployment insurance. There's another chunk there, that's 97 to add to the 143 in tax cuts. Corporate tax cuts, $88 billion. We really don't believe the corporate tax cut is going to be very effective in stimulating growth because a lot of that comes in the form of essentially deferring taxes. You get higher depreciation allowances up front through bonus depreciation. Maybe you can write off some extra losses up front. It helps cash flow this year, but it means that in subsequent years, taxes will be higher than they otherwise would have been. So I don't think it's a really big stimulus. State and local transfers, including Medicaid, $149 billion. That's large, and that's very, very important. And that makes a big difference because we know state and local government finances are in big trouble. We have to be realistic about how much that helps the economy. What that does is it prevents the states and local governments from making even deeper cutbacks in spending or bigger tax increases than they otherwise would have to. Because if they didn't get this help, they'd have to be making enormous cuts in spending and huge raises in taxes to balance their budgets. So this money funneled to the states helps dampen that, helps them get through without making extreme cuts. But there's no question there are cuts, and we know there are cuts in the state and local governments. Infrastructure and other spending, there's a lot of the focus on the stimulus package was on infrastructure. The infrastructure and other spending is $82 billion. I've included it in a separate line down at the bottom. You can see that compared to the rest of the package, it's actually fairly small. A lot of the original plans for infrastructure, the original hopes got scaled back as the package went through Congress. And also quite a lot of the infrastructure spending takes time to gear up and is going to come beyond the 2009-2010 period that I'm focusing on here. The overall time path the stimulus, we think about 2%, well, just less than 2% of GDP this year, and just more than 2% of GDP next year. And it does make a difference to our projection. If you look at GDP growth and compare what we have in our baseline and what we would have without this stimulus, without the stimulus, we'd probably have GDP declining more than 4% this year. And in 2010, doesn't show up too well on the chart, but we'd be very close to zero. You can't. There is a bar there for 2010, but it's only just above zero. So the stimulus does help us. It helps us by a bit less than 1% of growth this year and a bit more than 1% of growth next year. So it's large, it's important, it's not going to drive an economic boom. It does prevent things being much, much worse. It prevents the unemployment outlook from being worse. Without the stimulus, we'd have unemployment peaking a little over 11% instead of just over 10. It prevents the employment outlook from being worse. For employment, in our baseline, and this shows you the peak to trough decline in jobs. Baseline, the peak to trough decline is just over 7 million. Without the stimulus, we think the peak to trough decline would be a bit over 9 million. So again, it makes a substantial difference. Just bear in mind that where we are right now, as of this minute, the peak to trough decline in employment stands at 5.1 million. So that if you think of that and think of where we're going, that in our view, there's probably, in the baseline, probably a couple million more to come. And if that's going to be true, job declines will have to slow pretty substantially over the rest of the year, because at the moment we're running at about 600,000 jobs lost per month. And if we keep up that rate, we'll lose 2 million in almost 3 months. So we do believe that over the next few months, the rate of job decline will slow markedly. What about housing? Housing was the original source of the problems. There's good news in some senses here. Housing affordability is now exceptionally good. This is the National Association of Realtors Index of housing affordability. Taking it back here to the early 1970s. And it measures the ability of a family on median income to afford the median priced existing home using 20% down payment and a conventional 30-year fixed mortgage. So if this index is 1, it means that that family can just qualify for that mortgage. If the index is below 1, they can't qualify. If the index is above 1, they more than qualify. So the higher the index goes, the better able the median income household is to afford, the better able they are to afford the median priced house. The affordability index right now is an all-time high. And it's all-time high because house prices have fallen substantially and because historically mortgage payments are extremely low. So that's good news. It is a real stimulus to the market. The problem is, of course, the ability of households to qualify to get this mortgage, because of course to get this you have to have, you've got to have the 20% down payment. You've got to have good credit rating. Your employment prospects have to be, have to be solid. And not only you have to be able to qualify, you have to be willing to take the leap. You have to be willing to commit yourself to buy the home against the risk that although house prices are low now, maybe they'll be even lower 12 months from now. So you have to weigh the risk that you might still be buying a depreciating asset. But this is good news, and it's one of the signals that indicates that housing will soon start to turn around. But there are plenty of weights still on the housing market. The foreclosure rate is still extremely high. The data here goes through the end of 2008. So we've got the national foreclosure rate, which is the percent of all home mortgage loans entering foreclosure. That's the black line there. So that's around 1%. The worst hit markets, California, Florida, at the top, have substantially higher rates than that. West Virginia, running below the national rate. A more stable housing market here than in many parts of the country. We have to be a little careful on judging whether or not this foreclosure rate has peaked out, because over the last few months, many lenders essentially put a temporary moratorium on foreclosures while the administration put in place its foreclosure prevention plan. And that moratorium now seems to be over, so we could get a temporary jump in foreclosures as we catch up with what was put off, what was postponed. So I think we can be sure that foreclosures are going to stay high for a long time. And that's going to keep a lot of homes, extra homes, coming onto the market and probably driving prices down, house prices down further. So we think it's likely that home prices are probably going to undershoot any notion of long-term equilibrium, much in the same way as they overshot during the boom. The chart here shows you the price of homes, the FHA house price index, divided by wage compensation. So it's measuring the price of homes relative to wages. So it gives you, it essentially normalizes the price of homes for the level of income. And this chart is indexed to 1 in the year 2000. If you look back over history, there've been housing booms and busts, although not involving, the busts didn't involve national house price declines. They just involved prices rising more slowly than wages. But you look back to 1975, the boom seemed to start from an index level of 1. You'd move up in the boom, and then you go back down again to 1. And then you have a boom, and then back down again. This boom took us up to an index of almost 1.3, so the house prices rose by about 30% relative to wages. We're now on the other side of the boom. We're coming down very, very sharply. And we suspect that probably what will happen is that we'll undershoot long-term equilibrium. I'm still comfortable with that ratio of 1 being the long-term equilibrium, but we're going to probably undershoot. Do remember that in the housing market, a primary reason for foreclosures historically has been people losing their homes. So as long as the unemployment rate continues to rise, that's going to keep a lot of pressure on foreclosures, which will help drive prices down further, we believe. And we think we'll only very gradually come back towards that equilibrium level. Home sales, though, we think home sales will probably bottom out before prices. The chart here shows you existing home sales and new home sales. And existing home sales are on the left scale. They're much, much bigger than new home sales. New home sales are on the right scale. There's some very, at the moment, tentative evidence the last couple of months. Maybe we've hit bottom. We've had 1 month of improvement in new home sales. Let's not place too much credence on that. But it's better than a further decline. And we've seen a few months where existing home sales have been moving sideways rather than having a headlong decline. We think, given the depths to which the mortgage rates have dropped, given some tentative improvement in home purchase applications, that we're probably just about bottoming out right now on the home sales. But it's really going to take, we're going to need 2 or 3 more months of evidence. Nobody's going to, based on what you can see in the chart, I don't think anybody here is going to believe that we bottom out just from the evidence they can see in the last couple of months. We're going to need to see 2 or 3 more months of stability before we can say for sure that we've bottomed out. And even if home sales have bottomed out, we still have an issue with a backlog of unsold inventories of homes. So again, existing homes, new homes, number of months worth of sale on the market. For existing homes, it's about 9 months right now. For new homes, it's a bit over 12 months. So there's still a lot of supply out there on the market for sale relative to the sales rate. Now, of course, as the sales rate picks up, that will help this ratio, the ratio of inventory to sales, that'll help this ratio to start to come down. So the existing inventory will look more comfortable once the sales rate starts to pick up. But we've still got a big backlog to work off, and that's going to keep housing starts depressed. But we don't think it's going to drive housing starts down much further from where we are from where we are now. And that would be from a level of just over 500,000. The number today announced this morning for housing starts for March was 510,000. So that's roughly where we are, and that is about where we think we will bottom out, because that is enough. Housing starts at that level are low enough to bring down that inventory, even though sales are still very low. We think we bottom out this year and then gradually move forward as we go into 2010 and 2011. But it's a slow. We believe it's a slow rebound. What about consumers? Consumers are still depressed as far as their responses to surveys go, confidence surveys. This is the Reuters Michigan Sentiment Index, and it's running just below 60 right now. And you can see the only comparable period over the last 30 years or so was back in the early 1980s, where we dropped below 60 also. We'll get the next reading on sentiment tomorrow. I wouldn't be at all surprised to see consumer sentiment tomorrow, the first reading for April, showing some bounce upwards. I think that some of the increased optimism in the stock market is going to prove infectious, and that consumers will say that they're feeling a little better about prospects. So that'll be good news. I hope that we'll get tomorrow. But we're still very low, and there's so many problems weighing down consumers. Of course, we've got employment declining. They've suffered huge losses in wealth. Credit conditions are still tight. There are some pluses against that. One of the pluses are the tax cuts that I've already mentioned. Another plus is, of course, the decline that we've seen in gasoline prices. And I can illustrate you how much that's helped here in this chart. In this chart, the line is the pump price of gasoline, that's on the right scale, and the bars are how much consumers spend each quarter at an annualized rate on gasoline. So if you look at where we were in the middle of last year, spending a bit more than $400 billion at an annual rate in the third quarter on gasoline. As of now, with pump prices much lower, we're only spending a bit more than $200 billion. So it's almost like you consider it almost like a $200 billion tax cut for consumers. And it's actually a bigger impact than the actual tax cuts that the government is putting through in its stimulus package. So this is very important. However, I can't underestimate the wealth hit that consumers have taken. There has been a huge decline in wealth, both in the housing market and, of course, now in the equity market. Because the equity market decline, peak to trough, that we saw is, unfortunately, the steepest peak to trough decline in the stock market since the Great Depression. The bottom of the stock market, and hopefully I won't have to change this chart again, the bottom of the stock market was on March the 9th, 2009. At that point, the Dow Jones was down about 53%, peak to trough. So substantially worse than any of the other post-war bear markets, and not surpassed since 1929-32. What has happened to household net worth as a result of the stock market move and the housing market? From the end of the second quarter 2007, which was the peak level for household net worth, from there to the end of 2008, household net worth was down $12.9 trillion. Those are the official numbers from the Federal Reserve, which calculates wealth. From the end of the fourth quarter through March the 9th, our estimate is we lost another $3.6 trillion. So, if you think where we were on March the 9th, there's a total loss of wealth of $16.5 trillion from the peak, which is 26%. And another way to think of the order of magnitude is that $16.5 trillion is more than 1 year's GDP, because GDP is about $14.4 trillion. So there's a huge loss of wealth. Now, economists often talk about a wealth effect, the notion that people are more wealthy, it makes them more willing to spend on consumer goods. If they lose wealth, that will make them less willing to spend. Another way to think of it is that your wealth affects your saving rate. I mean, if your wealth is extremely high, you think, well, I'm well set for the future now, I don't need to save very much, and I can afford to spend. If your wealth falls very steeply, you think, well, my savings are now not what they were, especially if I'm nearing retirement. I need to save a lot more in order to rebuild wealth, therefore I will consume less. Now, estimates of the wealth effect on consumption range somewhere, I would say, between 3 cents on the dollar and 7 cents on the dollar. So, this is just to give a ballpark estimate. This is not by any means a precise estimate of the impact that there's going to be on consumer spending. It's just to give you a ballpark estimate of the order of magnitudes involved. If the wealth effect was 5 cents on the dollar, that loss of wealth would mean an $824 billion hit to consumer spending. And consumer spending happens to be around $10 trillion a year. So it makes it easy to do the arithmetic that that's about 8.2% of consumer spending, which is very big. Now, as of right now, we're not at the bottom anymore. The stock market's up about 20% from its trough. So, as of right now, the wealth loss is something like $13.6 trillion. It's not 16.5. If I apply the same 5 cents on the dollar to that, I'd come up with $680 billion as the consumption effect, 6.8%. Still very big, not as severe as 8.2, but just to emphasize that, as the stock market proceeds, the magnitude of this wealth loss is going to change. So this 8% loss is not written in stone as what we will need to see coming off consumer spending in the future, because some of that consumer spending loss, that's already happened. It happened in the second half of last year when consumer spending was falling 4% at an annual rate. But it does mean, I think the most important point to emphasize, that it is a weight on the consumer. And it will remain a weight on the consumer going forward. So we can't look to the consumer to drive a strong expansion in the economy as they have done in the past. It does suggest that the consumer spending recovery will be slow. So our outlook for consumer spending, and these are quarter-to-quarter annualized rates, is that the worst is over. I mean, we think the worst was the second half of last year, where you've got those 4% annualized rates of decline. We've got a small positive in the first quarter. We're a little dubious that marks the beginning of a sustained rebound. So we actually think the second quarter will be slightly below the first. And then we see a pickup gradually gaining momentum in the second half of this year and beyond. But the growth rates, they don't pick up. They don't match the same sort of rates we were seeing historically. We got used to often seeing consumer spending growth at 3.5% to 4%. We don't think we're going to see that on any sustained basis. What about business investment spending? Business investment spending right now is contracting very sharply. One indication of the decline in business equipment demand is given by orders for non-defense capital goods, excluding aircraft. It's quite a mouthful, but it is really the bellwether indicator of business capital equipment demand. It's quite volatile, so I've shown you a 3-month moving average here. These are levels, these aren't rate of change. So you see the orders, which is the blue line, the orders have been diving. We're almost back down to the orders levels we saw in 2003, 2004. And this chart would reflect both demand from US producers and export demand, because these orders numbers don't distinguish between whether it's a US order or whether it's a foreign order for a US-made good. But either way, business equipment demand around the world is plunging. And the shipments, which are the other line, the shipments are coming down. That's essentially a production indicator. But you can see that the orders have taken a bigger dive than shipments, so there's still some catching up needed to be done there on the shipment side. On the construction side, on the business construction side, I think the outlook is probably worse than it is for equipment. We've seen huge declines in equipment in the last couple of quarters, but I think the worst period for orders there, the worst is probably behind us. For business construction, the worst still lies ahead. The chart shows you business construction spending year-over-year growth, and that's the brown line. That's the line which, by the end of history there, is running at around 0 year-over-year growth. The blue line is something called the Architect's Billing Index. It's a diffusion index, and 50 means flat, above 50 is growth, below 50 is contraction. If you're going to put up retail developments, offices, whatever, you make the plans first. So the index of the architect's activity is a good leading indicator of the construction activity coming down the road. And that index was running substantially over 50. It started to dive at the beginning of last year, and it's now running at around the 35 mark. So it says business construction is going to fall very steeply, and that process has already begun. So, but there's, I'm afraid, much more bad news to come there. So if you're thinking of the economy and thinking of what's the one area that hasn't really been hit yet that is going to be hit very badly over the next year or two, it's business construction. I mean, think retail developments, we don't need more right now. Offices, we're losing jobs. We don't need to be building more offices. So it's business construction that's the problem. So that's a real issue for commercial real estate. So if you look at our forecast for business equipment spending and business construction spending, is on this chart here. The equipment spending is the brown line. And it has dived, I mean, to year-over-year drops of almost 20% right now, we think. But it comes back because companies, as they see the economy starting to stabilize, will think, yes, okay, we cut back dramatically. We didn't know how disastrous the outlook was going to be. Now things are starting to stabilize, look a little better. We're ready to move forward again with plans that we may have delayed for purchasing equipment. So the equipment comes back. But the construction cycle is lagging. Construction, a year from now, down 20% or so year over year. And it takes longer to come back than the equipment. The foreign trade picture, I've already emphasized how badly the rest of the world is doing. And that showed up very, very dramatically in the ISM export orders index. I showed you the ISM overall manufacturing index before. This is the export orders component of that. Exports were doing very, very well for years. We had something like 70 months in a row of export growth, this index running above 50, often substantially above 50. Went off a cliff, down to almost 35. Last couple of months, hints of stabilization. The index has edged upwards. But from what we can see around the world in foreign economies, that the glimmers of hope that people are seeing in the US economy not really being replicated around the world, except perhaps in China, which is the one place where the government's really able to pump in a huge amount of stimulus into that economy to keep it going. So China has slowed a lot, but is doing much better than most others. Europe, other parts of Asia, particularly Japan, still doing very, very badly. So in terms of the export-import outlook, the chart just shows you export growth and import growth. Export growth had been outpacing imports. So export growth is the blue line, and if you look at last year, we were seeing double-digit year-over-year export growth, even as our economy was starting to slow, which was slowing the rate of growth of imports. So trade was really helping us. But now the export growth has dived. So, of course, of imports. I mean, and that's been a big reason why the rest of the world's been going down, because our demand in the US for their products just has been evaporating. Looking forward, we expect imports to come back before exports. So you can see that the import line moves up more sharply and moves into positive territory before the export line. So it's a reflection of the notion that the US is probably going to recover before the rest of the world. So what we'll be doing, we'll be generating import demand, which will help the rest of the world. rather than having the rest of the world coming back and generating export demand, which will push us up. So they're still looking to the US to help them. The dollar, as I noted earlier, has moved up somewhat. This shows the dollar on a trade-weighted basis, adjusted for inflation against major currencies, which you can think of as really being the G7 currencies. That's the blue line, and against other currencies, which is the brown line. Other currencies will be dominated by China and Mexico. Whichever currency you look at, the move up in the dollar that we've seen recently comes nowhere near to removing the depreciation that we saw since the dollar's peak, which was around 2002. So the dollar is less competitive than it was, but it's still pretty low by historical standards. So important lesson there, we cannot blame our export collapse on the dollar. I mean, the dollar's moved up, but it's not the source of the export collapse. That's just evaporating global activity that's caused exports to collapse. Longer term, as I mentioned earlier, we expect the dollar will start to trend down again because of in large part, the magnitude of the borrowing that we're going to have to continue to do. Inflation and interest rates. I've already given you the story here on inflation. The CPI, by the third quarter of this year, we think it'll be down almost 3% year over year. And that's all about gasoline and to some extent food. Lower food prices they're helping the consumer. We saw food falling in the CPI this week. That's good news. Excluding food and energy, we see the inflation rate dipping, maybe around 1% or so, dipping to 1%. But that's not the same thing as deflation. Deflation would occur if we were to see that core inflation rate heading down towards zero or even falling below zero. Deflation is still a risk. It's a reason the Fed has been so aggressive. We think there's probably been enough stimulus in there that we will not fall into a deflationary spiral. And for the Fed, on its interest rate, we think it keeps the federal funds rate low, near zero, almost all the way through 2010. Now, there clearly are risks. Normally, pumping up the money supply, and the Fed, the way it has done, will be a major inflationary risk. And in the long term, the Fed is going to have to consider very carefully how it extricates itself from all the stimulus that it pumps in, how quickly to withdraw that stimulus. Can it do it quickly enough without putting the recovery in jeopardy, but at the same time without running the risk of an explosion of inflation? That will be an important issue for the Fed in 2010 and 2011. If we don't withdraw the stimulus quickly enough, we will be at risk of higher inflation. Right now, though, it does remain deflation that's the key risk. In the government budget, in a similar way to the Fed, the government is going to have to consider what does it do on the fiscal side to withdraw all the stimulus that has been pumped in. Because the government deficit we're going to be running this year, the bar shows you the deficit in dollar terms. It's almost $2 trillion budget deficit for the federal government. The line shows you it in percent of GDP terms. That's on the right-hand scale. It's more than 10% of GDP budget deficit. We can't possibly afford to run deficits at that order of magnitude for very long. I mean, I think right now it is the right thing to do. I agree with what the government has been doing. I agree with all the stimulus it's been pumping in. We can't run deficits of that magnitude for long. Two things will help us out. One, the way the deficits are measured, all the capital that the government's been pumping into banks, on this deficit measure, the Treasury's measure, that counts as a cash payment. It's a cash outflow. So it's been boosting the deficit. Some of that capital will be repaid. Now, very likely on some of it, the government will make a loss. But a lot of that capital, most of it, will be repaid. As that gets repaid, that's a cash inflow and will reduce the deficit. So that's one thing that will help us over the next couple of years. But I think there's no question that we are going to have to see some serious tax increases over the next few years if we are to bring the budget deficit down. Certainly if we're to bring it down to the sort of levels that we're projecting in the longer term forecast, which is even still around 3% of GDP. It's not zero, it's still 3% of GDP. And you can see how we do it in our forecast. The chart shows you this is the average effective federal income tax rate. The best that we can measure it, given the aggregate numbers we have in our model of the economy. We try to calculate in our model a measure of total taxable income, total taxable personal income. And then we compare that with the amount that's being paid in federal income taxes. And we divide the tax by the taxable income, and that gives us an average effective tax rate. You can see we're running at an effective rate of around 16% or so as of right now. Historically, we've been in the 20 to 24% range. Remember, we had the Bush tax cuts early in this decade, 2001, 2003. We followed that up with a series of temporary cuts last year and this year, which are keeping the rate very, very low. Our forecast assumes that once we get to 2011, one way or another, those taxes have to go up, and have to go up pretty sharply in order to get us back up to what is to the historical range. And we don't think, although the administration is hoping to do it by just taxing the rich, we just don't believe there's enough capacity there to pay taxes to just do it by taxing the rich, i.e. just by taxing people making more than 250,000. One way or another, we think there's got to be some broader tax increases in order to get the budget deficit down. We have it happening through the income tax side, but it may well be that other measures will come under consideration. I was hearing this week that the President has asked his key economic advisors to take another look at the tax code, another look to try to and report back to him later this year on ways to reduce complexity. I mean, we know right now that the income tax code is just incredibly complex. The idea of comprehensive tax reform to simplify things will almost certainly come back onto the agenda. And as part of that, the idea of perhaps a value-added tax will come back onto the agenda as an easy means to generate substantial amounts of revenue. So you have to be aware, 2-3 years out, we are going to be looking at, one way or another, at higher taxes. And I hope, personally, that it will be in a way that simplifies the code, because it is just outrageously complicated right now. So, to conclude, the story is a mixture of very bad news, a lot of which is in the past, and with the acknowledgement that there's going to be plenty of bad news still to come. But with the notion that in terms of the period of free fall, what I would characterize as free fall, I think that was the fourth quarter of last year. I think that was the first quarter of this year. I think the free fall period is coming to an end. We have some hints of stabilization appearing. That doesn't mean we're ready to grow. It does mean that we're going to be contracting more slowly, and by the end of the year, we may actually be growing again. There's plenty of public action to support growth. More fiscal stimulus is coming. Probably there are going to have to be more injections of public capital into the banks before we're done. The Fed's cut to zero. I mean, the impact of cutting interest rates to zero has been limited. But as noted there, its unconventional measures will be extended. Those include what it's doing now with actually buying treasury bonds outright. And it's probably going to have to continue to do that. And as of right now, I think it's legitimate to speak of both upside risk and downside risks. Because I think for most of the last few months, we always have to give, here are the upside risks and here are the downside risks, but to some extent, when we've talked to the upside risk, we've been paying it lip service, but haven't been really convinced that we can see an upside case out there. I think there now is a more legitimate upside case. Notion that the credit markets may be starting to stabilize. The fiscal stimulus perhaps could kick in more strongly than we anticipate and generate a more rapid upswing. Not a boom, but a more rapid upswing than we've built into our baseline. There are still, though downside risks, and the downside risk is just the negative vicious spiral between the economy and the credit markets. We can't be sure that we've hit bottom in that. what has been happening is financial market losses mount, banks become less eager to lend, takes the economy down further, more losses, banks even less willing to lend, economy down. That's the vicious spiral that we've been in. And all of the government actions by the Fed and the Treasury, they've all been directed to trying to cut into that, to try to cut that cycle off and to underpin the economy and set the stage for growth. I think the actions are probably starting to work, so I don't see quite as a severe downside risk now as maybe I would have done 2 or 3 months ago. But we do, unfortunately, still have a long way to go before we can say we're out of the woods. Thank you very much for your attention. And I can take a couple of questions if there are any. Yes.
The downside risk you speak of, there's a lot of discussion about the credit card market, obviously, commercial real estate. Is that what you're speaking of?
Yeah, I mean it's really the shoes that haven't dropped, if you like, and clearly we can see mounting delinquencies on the credit card side. And I noted earlier that probably number one, I would say, is the commercial real estate risk in terms of shoes that haven't dropped. And it's a different type of risk than the ones we've seen previously, because the problems with subprime lending, those have generally impacted, big banks, the big operators. They were the ones who took the big bets in that area. The smaller banks, more regional banks, generally didn't get exposed in that area. The smaller banks would be more exposed on the commercial real estate side. So we could see the crisis, spreading out. It would mean many more institutions involved in terms of order of magnitude of size. If you add together those institutions, they're probably not going to add up to as big as the ones that are in the serious trouble. But it would broaden out the credit crunch, broaden out the downturn to involve many more banks, and so you'd see a substantial increase in bank failures potentially as a result of the commercial real estate side. So, yeah, absolutely, that's where the risks are. Yes.
Do you have any comments on healthcare reform?
It's absolutely key in the longer term to getting the budget deficit under control. I mean, I didn't mention it in the short term because in the short term, there's no alternative but to have higher taxes. In the longer term, the problem is it's actually not so much the aging of the population; it's the rate of increase of healthcare costs. So that's one way or another. If we're going to get health under control as a driver of the budget deficit, we have to find ways to reduce the rate of growth of costs. And I mean, historically, what has always been very, very difficult is how do you get the cost growth under control without at the same time looking at like you're dramatically reducing the freedom of individuals to choose the healthcare that they want. I mean, I think it's inevitable that we are going to, one way or another, to move towards a system in which there's more government involvement, not necessarily, I wouldn't say a nationalized healthcare system. I think that there's far too much opposition to that, but we're going to have to move towards a system in which there is probably more government action. And I'm afraid it will also mean that in some areas, I think that people probably won't be able to get what they might consider as their right, which might be, the most up-to-date treatments, the most expensive treatments. They're probably not going to be available to everybody in the same way that they have been in the past. Especially because one of the objections of the administration is to broaden healthcare coverage to more people. It's a lot of extremely, extremely difficult choices. But in one way or another, people's ability to choose whatever healthcare they want is probably going to have to be circumscribed somehow. It's going to have to be reduced. Okay, thank you.
Dr. George Hammond heads up our forecasting program. He's the Associate Director of the Bureau of Business and Economic Research and Associate Professor of Economics in the WVU College of Business and Economics. He conducts these forecasts at both the state level. We annually have George produce forecasts that now 4 governors have used in their budget presentations to the legislature. We also do forecasts for other parts of the state, and you can find on our website information about those forecasts. So I encourage you, if you're interested in tracking the forecast quality, particularly at the state level, he annually provides in his forecast publication information on those forecasts. And I do believe outside at our desk, we do have copies of the 2009 Economic Outlook forecast for the state, and you can pick up a complimentary copy of those at the next break. So with no further ado, I'll turn it over to George to talk about the outlook for the Morgantown area.
It's nice to see all of you here this morning. Thank you for coming. Now, it's my job to talk to you about the outlook for the Morgantown metropolitan area. And the way I'm going to do that is by first discussing where the state economy is and where I think it will go over the next couple of years. And then we'll zoom in on the Morgantown metropolitan area and see how Morgantown stacks up against both the state and the nation. And then we'll look at where I think the Morgantown economy is headed over the next year or so. Now, over the last 15 years that I've been giving these sorts of presentations, I've developed a habit of giving my audiences a sense of how they'll feel once I'm done discussing the outlook. And I think this good news, bad news dichotomy is maybe the way to go in terms of giving you a sense today. And as an economist, I'll start off with the bad news. And the bad news is that I have a pretty bad head cold this morning. And maybe that's, bad news more so for me than for us. And the good news is pretty much everything I'm going to tell you about the Morgantown metropolitan economy. And the Morgantown economy has been one of the strongest growing economies in the state. Indeed, it's been one of the stronger economies nationally over the last year or so. But the outlook is also fairly strong for the Morgantown metro area. Morgantown is very likely to bypass the national recession. It's likely to do much better than the state. But the one thing to keep in mind, and this is a point I'll return to in a few moments, is that no local economy is recession-proof. No local economy is bulletproof. Every local economy depends to some extent on what happens nationally and even globally. And Morgantown is no different in that respect. And this starts to matter with respect to the outlook because while I think Morgantown will continue to grow, that growth is going to be slower than what we've seen over the past couple of years and likely fairly slow in 2009, although I do think there will be growth. So with that little bit of introduction, let's jump in and take a look at the West Virginia economy. Now this graph shows jobs for West Virginia and the U.S. so far this decade. And the first thing to notice from this graph is that both West Virginia and the U.S. Fell into a recession earlier this decade. That was in 2001, and West Virginia started losing jobs at around the same time as the national economy. And by the same token, West Virginia started adding jobs at about the same time as the national economy, and that happened roughly at the middle of 2003. Now, from the middle of 2003 through the third quarter of 2008, West Virginia added about 36,000 jobs. And that translates into an annual rate of growth of almost 1% per year. Turns out that's about equal to the national rate of job growth during the period. Now, as you can see from the graph, the national economy really started losing jobs and fell into the current recession starting about December of 2007. Now, West Virginia held on pretty well. Our job growth decelerated actually in 2006. We continued to grow through August of 2008. But by August of 2008, West Virginia was essentially sucked into this national downturn. And during the past 6 months, roughly from August of 2008 through February of 2009, West Virginia has lost 13,000 jobs. And that translates into an annualized rate of job loss of 3.5% per year, which is bad by any measure. But it's not as bad as what's been happening nationally, where that job loss over the same 6-month period is about 5% at an annualized rate. So West Virginia has been hit hard. We had that sort of Wile E. Coyote effect where it looks like, we essentially fell off a cliff. And West Virginia is solidly in this national recession at this point. But even so, the job losses in West Virginia are coming at a slightly slower pace than we're seeing for the nation. Now, those job losses are showing up in the state's unemployment rate. Now, notice from this graph that West Virginia has made a lot of progress over the last 30 years in driving its unemployment rate down to the national average. That percentage gap between the West Virginia and U.S. rates averages about 5 percentage points during the 1980s. It's down to about 2.5 percentage points by the 1990s, and then West Virginia's unemployment rate has been essentially equal to the national average so far this decade. Now, with the job losses over the last 6 months, West Virginia's unemployment rate has spiked up, as has the national rate. The national rate is up to 8.5%. West Virginia's rate skyrockets as well, going from about 4.1% in early 2008 to 6% by February of 2009. According to the latest data from March of 2009, we're now up to 6.9% in terms of the state's seasonally adjusted unemployment rate. So we are seeing, the mirror image of this national downturn, unemployment rate skyrocketing. But notice how this compares to previous downturns. In terms of the nation, that 8.5% unemployment rate is as high as we've seen since the early 1980s. But notice that for West Virginia, even at 7%, we're not even close to the unemployment rate we saw during the recession of the early 1990s, and we're nowhere near what happened to the state in the early 1980s when the unemployment rate peaked at over 18%. Now, in terms of where those job losses occurred, I wanted to give you a sense of how things have broken out for the state by industry over the past year. And the way I've done that is each industry has 2 bars. The white bar shows the change in jobs from February of 2008 to August 2008, and the blue bars show the job change over the past 6 months. Now, West Virginia was still growing, although just barely during most of 2008. But notice that we were seeing some job gains in natural resources and mining, as well as construction, healthcare, government. There were some rays of hope, some net job gains. Over the past 6 months, even those rays of hope have essentially disappeared, and we're now seeing job losses across all sectors. And that includes construction, manufacturing, trade, as well as professional and business services. So it's a widespread decline. But notice those big job losses in construction. And construction's getting a lot of press these days. And one of the ways that we track construction activity is by some data from FW Dodge. And FW Dodge reports the value of new construction contracts. And ideally, the way this data set works is that the entire value of a project will show up in 1 month, ideally about 60 days before groundbreaking. Now, the Dodge breaks this data out by 3 categories: the non-building, non-residential, and residential activity. Now, non-building activity includes infrastructure spending like highways, roads, water, and sewer, but it also includes power plant activity. And you'll notice a huge spike in this activity in 2007, and that's primarily driven by 2 large power plant projects in Montague County. That's Longview and the installation of scrubbers at Fort Martin. But overall, what we see for this data is a big decline in the value of construction starts in 2008 compared to 2007. Now, even if we remove the power plant activity from 2007, we still get a 30% decline from 2007 to 2008. And that's reflected in the decline in both non-residential and residential activity. Now, the residential activity is getting all the press these days. And notice that West Virginia followed in a way, the national housing boom, right? We get a big increase in the value of residential starts from 2001 to 2006. That's up by about 270% during the period. And by the time we get to 2006, this residential activity is remarkably unevenly distributed across the state, because in 2006, about 60% of the value of residential activity is located in just 3 counties, and those are the eastern panhandle counties. Now, since 2006, that residential activity is down by roughly 50%. And the eastern panhandle activity is driving that because that accounts for about half of that 50% drop. So overall, what we're seeing is that the housing correction is reflected in West Virginia as well, but where we see the biggest impact of this housing correction is in the markets that were really booming, especially out in the eastern panhandle region. And we can get another perspective on this whole story by using data on house price appreciation. And this graph shows data from the Office of Federal Housing Enterprise Oversight, now the Federal Housing Finance Administration. And the thing to keep in mind about this data is it tracks repeat sales on single-family homes whose loans are eventually sold to Fannie Mae or Freddie Mac. Now, the thing to keep in mind about this is that those loans max out at $417,000. So we miss the very high end of the housing market with this data. The trade-off here is that we get pretty good geographic coverage. We get data for all metropolitan areas in the nation, and they're even publishing now data for non-metropolitan portions of states. So this graph shows house price appreciation for 2 periods. The colored bars show house price appreciation over the past year. The gray bars show house price appreciation over the previous year. And notice that overall we see house price appreciation slowing significantly for the nation. House prices drop over the past year by 4.5%. For West Virginia, house prices are much more stable. They're roughly flat or maybe down a little bit. For most of the metropolitan areas that include counties in West Virginia, we're seeing slower house price appreciation, maybe small declines. Now, the exception here are those metropolitan areas that include West Virginia's eastern panhandle counties. Think of Winchester. They're down 17%. That includes Hampshire County in West Virginia. For the Washington metro area, they're down 12%. That's Jefferson County. And the Hagerstown-Martinsburg metro area includes Morgan and Berkeley counties, and they're down by 8%. And keep in mind that those 3 markets each saw their house prices roughly double during the first half of the decade. So it's those boom markets that are primarily getting the bust. For the rest of West Virginia's local markets, they didn't experience the boom to the same degree, so they're better positioned to deal with the slowdown. So where's West Virginia headed? Well, West Virginia is in a recession, and the recession is going to deepen through 2009. You're going to see job losses, much higher rates of unemployment, and slower income growth in 2009. Now this downturn is already more severe than what we saw in the early 1990s and more severe than what we saw in 2001. However, it's not likely to be as severe as the state downturn in the early 1980s. Remember, that's the period where we have an unemployment rate at 18%. During that same period, West Virginia lost 76,000 jobs. It's roughly 12% of our employment gone. In addition, if the national and world economies rebound in 2010, that really sets the stage for the West Virginia economy to rebound as well. I think we'll see job growth return to the West Virginia economy in 2010. Overall income growth starts to rebound, and we then grow through 2013, or the end of the forecast period. Now, while West Virginia, I think, will grow on average over the next 5 years, that growth is going to be pretty slow, even compared to the national average. And when West Virginia generates positive but slow job and income growth, that generally means that we have trouble attracting more residents to the state than we lose to other states. So we get essentially no net migration into West Virginia. And West Virginia remains demographically challenged. We remain the only state in the nation that has recorded more deaths than births so far this decade. Then when you put those 2 things together, little net migration, no natural increase or natural decrease, then we get essentially no population growth or very little population growth into the state. And that sets us up for another phenomenon, which is a rapid demographic aging of the state's economy. And this graph is designed to give you a sense of how that has worked out over the past couple of years and what we're headed for over the next couple of years. Notice we've been losing population in the school age group, the 18 to 44 age group. We've seen a little bit of population growth in the 65 and older age group, but really most of the population growth has been in that 45 to 64 group, and that's the baby boom generation. But notice what happens over the next 5 years. This trend completely changes, and we start to see the 45 to 64 age group peak and begin to decline, and what picks up the slack is the 65 and older age group. And this is the aging of the baby boom generation into that 65 and older age group. And that has big implications for both the nation and for West Virginia. I mean, the aging of the baby boomers have had big impacts on the economy and on social, cultural life, and every life transition they've gone through so far, and this one will be no different. Now, the baby boomers will have a big impact on the labor market, particularly as they begin to retire. Now, nothing has happened in the last year that has encouraged anyone to voluntarily retire. But the fact of the matter is that the baby boom generation will eventually begin to retire in large numbers. And when that happens, they're going to create job openings. And the thing to keep in mind about the baby boom generation is that they're unusually highly educated. And that means that the job openings that their retirement creates are going to be for relatively high human capital jobs. And that will mean that we'll have opportunities for graduates from West Virginia's higher education institutions. And I've been tracking a data set from the West Virginia Higher Education Policy Commission that tracks the degree to which graduates from state public higher education remain in the state to work. And what we find is that of the graduates during roughly the past decade, a little bit less than half remain in the state to work. But notice that that work participation rate is gradually rising. It was up in 2007 over 2006, and the wages rose as well. And one of the implications of the retirement of the baby boom generation is that we may see this work participation rate rise further in the future as those job opportunities for highly educated individuals increase. Okay, that's where the state economy is at the moment and where it's headed. Let's talk about the Morgantown metropolitan area. Now, the Morgantown metro area has been a real engine of job growth for the state economy so far this decade. The metro area has added a bit over 13,000 net new jobs during the past 8 years. And that translates into somewhere between 1/3 and 1/2 of total state job growth during the same period. In addition, it's far more jobs than were added by the Eastern Panhandle region, kind of the other part of the state that's considered very dynamic and fast-growing. Eastern Panhandle only added about 6,000 jobs so far this decade. So the Morgantown metro area has been very fast-growing. It's been an engine of job growth so far this decade, and the same was true over the past year. And this graph shows job growth over the past year by county. And you'll notice that the Morgantown metro area, which includes Monongalia and Preston counties, added about 1,700 jobs during the past year. And that translates into a rate of job growth of about 2.8%, and that's far better than the state's rate of job growth, which was just 0.4% or roughly flat. And the national economy lost jobs during the same period. So we have no growth for the state, job losses for the nation, and Morgantown grows by almost 3%. Now keep in mind also from this graph that Morgantown remains an engine of job growth over the past year, but the Eastern Panhandle essentially slips into reverse. Eastern Panhandle lost about 600 jobs over the past year. That's primarily driven by job losses in construction, also layoffs at a large call service center and warehouse operation in the Eastern Panhandle. I wanted to give you a sense of how Morgantown's job growth has both breaking out across industry and how it stacks up against the state and the nation. Now, Morgantown's job growth has been fast on average during the past 5 years at roughly 3% per year, and keep in mind that's triple the state rate of job growth and triple the national rate of job growth during the past 5 years. Most of the job growth that we've seen in the local economy has come in service-providing sectors like healthcare, leisure and hospitality, which is hotels, motels, restaurants, and bars. We've also seen strong gains in government, as well as professional and business services and trade. But one of the really striking things is that we've continued to see job growth in the Morgantown economy in manufacturing. And notice that's a huge contrast with what we've seen for both the state and the nation. So Morgantown's adding jobs in manufacturing at a really rapid clip. The state and the nation are losing at a rapid clip. And in part that's due to the concentration of pharmaceuticals manufacturing with Mylan located locally. But Mylan wasn't the only manufacturer to add jobs. There were others as well during the same period. So Morgantown's growing quickly. That job growth is really well diversified, both across service-producing sectors and the goods-producing sectors as well, including construction and natural resources and mining. So Morgantown's growing fast so far this decade. It's growing fast over the past 5 years. Morgantown has also tended to grow fast over longer time periods. And this graph shows employment trends over the last 38 years. And Morgantown's job growth over this 38-year span averages roughly 2% per year. And that's double the state rate during the same period, and it's even above the national rate of about 1.7%. So Morgantown has a long history of growing faster than the state and at least approximating or beating the national average. But one thing I want to get to at this point is to talk about business cycle sensitivity. And to give you a sense of that, I put the national recessions here, which are shown by the blue bars on the graph. Now, notice that Morgantown has not been immune to national downturns. It went down during the recession of the mid-1970s, also the recession of the early 1980s, and those were severe national downturns. The national recession of the early 1990s was a mild national downturn, and Morgantown pretty much skated by that one. The recession in 2001, another mild national downturn, and Morgantown again pretty much makes it through that unscathed. So Morgantown has responded to these national downturns in the past, but it's not immune. It is affected, and part of the reason why the Morgantown area has been a bit less sensitive to the national business cycle, particularly over the last couple of downturns, is related to its employment mix. So if we think about the Morgantown metro area, it's got a large share of jobs in government, as you would expect, with a relatively small town with a state university. So WVU tends to drive up those government jobs, as do the federal employers in the region, including the prisons in Preston County, other federal employers located around the metro area. So we have a relatively large share of government jobs. About 27% of total jobs are in government in 2008. We've also got a large share of jobs in healthcare. About 20% of these healthcare jobs, about 20% of total jobs are in the healthcare sector, and that reflects the hospitals locally as well as the university. Again, so we have large concentrations of jobs in healthcare and government. And for the most part, these sectors tend to be less sensitive to a national business cycle. Sectors that tend to be more sensitive to the national business cycle would be manufacturing, where Morgantown has a relatively small share, professional business services, again, a relatively small share. So Morgantown essentially has large shares of jobs in the less business cycle sensitive sectors and smaller shares of jobs in the more business cycle sensitive sectors. And that sets us up to be less sensitive than average to a national downturn. That's not the same thing as being immune. We're less sensitive, but not immune. If the national downturn is bad enough, it can impact employment growth both in healthcare and government. After all, government is not inventing the funds to pay state government employees or engage in these public projects. Those funds come from the overall economy and overall economic growth. Things get bad enough, we can see slower job growth, and indeed in some parts of the country we are seeing layoffs in the healthcare sector, and that can happen locally as well. So Morgantown's less sensitive, not immune to the national business cycle. And finally, construction. Talked about this a lot in terms of the state. I also wanted to give you a sense of how this breaks out for the local economy. Now, the thing to keep in mind about this figure is that I've removed the two large power plant projects in the local area, both Longview and the Fort Martin scrubbers. And I do that because if I don't, these bars that you see here are so small that you can't tell, you can't pick out the trends. So those power plant projects are huge compared to the scale of the rest of the building activity that we see in the local area. But what we get if we look at this data is a similar slowdown in construction activity locally, similar to what we saw for the state. That's reflected both in the non-residential activity and also in the residential activity. So notice that Morgantown followed in some ways that national trend towards increases in residential activity. It's now looks like it's slowing down a little bit in 2008. Notice that spike finally in 2007 reflects in large part some large multifamily projects that have gone up. And the thing about those multifamily projects, particularly the big ones, is they tend to happen. They create a big spike in the data, and then we wait a couple years as that inventory gets drawn down and accommodated by the market. So not a big surprise that things slow down in 2008, but overall it looks like construction activity is set to slow somewhat in the Morgantown metro area. And that brings us to the crystal ball part of the talk, where we think about the outlook for the Morgantown area. And this graph shows job growth in the Morgantown area, comparing the outlook for the next 5 years to the outlook for the previous 5 years. The outlook calls for the Morgantown metro area to grow on average during the next 5 years. That growth rate is expected to be about 1.2%, and that's significantly slower than we saw during the previous 5-year period. So overall, I think the Morgantown metro area is going to continue to grow. I think we'll grow each year. That means growth, but slow growth in 2009, and then each year through the forecast. Overall, that growth, even at 1.2%, is much faster than what's expected for both the state and the nation. And just to give you a sense of this, that 1.2% is quadruple the expected state rate of growth and triple the expected national rate of job growth during the same period. So Morgantown still does a lot better than both the state and the nation, but that activity does slow down. Now, in terms of overall job growth, construction jobs slow, get a little bit of additional job growth there. In part, that reflects the power plant activity, as well as continued residential and non-residential investment locally. Manufacturing activity slows again. Most of the job gains are going to come in these service-providing sectors, and it's the same sectors that have driven the growth in the past. It's healthcare, leisure and hospitality, government jobs, and even to some extent professional and business services. So overall, Morgantown remains relatively robust. It's just things are just going at a slower rate over the next 5 years. Now, that job growth generates income growth, and this is really what we all care about at the end of the day. And the forecast calls for the Morgantown area to generate per capita personal income growth at rates that are much faster than are expected for either the state or the nation. Now, notice here that the Morgantown metro area has already made a lot of progress in closing the per capita income gap with the nation. And that gap started out at over 26% in 2000. By the time we get to 2006, our last year of historical data, that gap is down to 18%. And the forecast calls for that gap to continue closing during the next 5 years, as Morgantown does better over the next 5 years than does the nation or the state. So we're both going to be better off, and we're going to feel better about it as we close the gap with the national economy. And finally, the unemployment rate. Do you think the unemployment rate locally is going to bounce up over the next couple of years? But I also think it's going to remain well below the rates that we'll see for either the state or the nation. And that means that Morgantown's labor market is going to remain relatively tight. And for employers, that means continuing to have to work hard to find the skilled and even the unskilled labor that we need to make our operations run locally. So let's sum up. The outlook for the Morgantown metro area remains relatively optimistic. We're looking for growth in the local economy in terms of job growth at rates that far exceed both the state and the nation, although it's below the growth that we've seen over the last 5 years. In terms of the unemployment rate, the labor market remains relatively tight, although unemployment does rise a bit over the next couple of years. Population growth remains solid, and income growth exceeds what's expected for both the state and the nation. And we're now at the part of the Outlook talk where I essentially think about ways that my forecast can go wrong. We also call this covering my rear end. So in terms of risks to the local outlook, we're emphasizing this, I think, and I'm not the only one locally who's talking about these sorts of things, but there's some people from outside the local area and even outside the state have emphasized or put forward the argument that the local economy is recession-proof. This is not true. So one risk for the local economy is a risk of a deeper or longer national downturn. The national economy turns out to be even worse in 2009 than expected. If it turns out that we wind up in a 2 or 3 year national recession, that's going to reduce Morgantown's growth further. It's going to reduce Morgantown's growth further than is currently expected. So we're not immune. Related to that are risks related to our relative concentrations of jobs. We have high concentrations of jobs in healthcare and government. Now, those two sectors tend to be less sensitive to overall business cycle trends, but they're not immune. If things get bad enough, that puts significant pressure on public budgets. That can reduce overall employment in government, both at the federal, state, and local levels. It can also put pressure on healthcare. In addition, healthcare is going to be an increasingly important issue going forward in terms of restructuring that, finding ways to provide healthcare more efficiently and in a less costly way, and that can also generate risks to the outlook for healthcare jobs. Finally, Morgantown is likely to remain one of the most dynamic economies in the state, most likely the most dynamic economy in the state, the most fast-growing economy in the state. And that generates a risk related to infrastructure. We need to continue to think about ways to make sure that the infrastructure that we have accommodates the growth that we are generating based on our high levels of human capital and the other growth advantages that we have here locally. Now, keep in mind that infrastructure spending ideally accommodates growth. If you build a road to nowhere, you get nothing. But for local economies like Morgantown, which have the other ingredients that we need to generate local economic growth, we do need to make sure that we have that infrastructure in place to keep that growth rolling along. And with that, I'll conclude my formal prepared remarks, and I'd be happy to take a couple of questions if there are some. Yes, ma'am. The question is why the growth in the leisure and hospitality sector. Leisure and hospitality reflects growth in both in hotels, motels, restaurants, and bars, also the gaming sector of the local economy. And that's one of those sectors that responds both to overall population growth, also to new investments in hotels, motels, that sort of thing. We have some of those still coming online. This is likely to still be a fairly favorable environment for restaurants and bars. College towns always are. And in addition, that small gaming sector is likely to continue to expand as the region's population grows. Yes?
Pointed out a couple times in the presentation, in Monmouth County, there's two of the largest construction projects in the state and the region underway. Two power plant projects, which combined are probably adding over 1,000
The question is relates to the construction job growth. We have these two large power plant projects that are underway in the local economy, and those are, certainly were and probably are generating large numbers of construction jobs related to that activity. It's likely that not all of those jobs are being picked up via the employment statistics that we have. Construction jobs are tough jobs for the Bureau of Employment Programs and the Bureau of Labor Statistics to track. It relates to essentially tracking the establishment. The way those jobs are measured is by where the establishment is. And for the most part, when these large projects start up, an establishment is created at the work site, but not always. And that can create distortions between what the groups or individuals doing the construction say the job impact will be and what we actually see in these employment numbers. So there's a little bit of a reconciling issue there in terms of the exact number of construction jobs are. We never get those quite right when measuring construction for small geographic areas. So I think it's entirely possible and indeed probable that we've seen actually faster construction job growth than is picked up by the numbers. So keep that in mind as you consider that data. Yes?
Why such a big decrease in the natural resources mining forecast?
Yeah, the question is why the big decrease in natural resources and mining? Essentially, that's the big shock to the closure, related to the closure of the mine in Preston County. That creates a big one-year hit that then we get gradual growth from that decline. So what you see is an average 5-year growth rate, and essentially what's happening is the level goes down and then grows slowly, but doesn't make it quite back up to where it was. So we'll see in terms of the outlook for natural resources and mining and coal. Everybody's watching the spot coal prices. Those tripled roughly over the kind of the early 2007 to the August 2008 period. We saw a tripling in spot coal prices. Those have now fallen by a little bit more than half, and that's along with the global slowdown is affecting the levels of activity. It seems like the slowdown so far in the coal mining sector is more concentrated in the southern part of the state than in the northern part of the state. So without that one big closure, I think we would have seen kind of slow growth in the local area in terms of that mining employment. Yes? I'm sorry. The question relates to the apparently there are reports circulating about a financial cliff that the state falls off of about 2012, and the question is why doesn't my forecast reflect that? And unfortunately, I can't explain that. I haven't seen those reports yet, or I haven't had that brought to my attention. I haven't discussed it. I'll give the state's revenue director a call today, and if you want to give me your business card, I'll give you a call back once I have a chance to talk to him. So I apologize for that. One last question. If there are no takers, I will turn it back to Tom. Thank you very much.
Each year, as part of the Morgantown Economic Outlook, along with the other economic outlooks conferences that we do around the state, we try to bring in people locally who will talk about specific sectors that are of particular interest to us. We were pleased to have 3 individuals join us today who are going to talk about specific aspects of the Morgantown economy. After I contacted them and got their agreement to come and talk to this group, I suddenly discovered they were all 3 graduates of the College of Business and Economics. So it's with some additional pride that I am pleased to bring them to you. We'll first hear from Bill Burton, who's the broker owner of Bell Cross Properties, to talk about the real estate sector. Bill?
Good morning, everybody. It's a pleasure to be here. Otherwise, I'd be probably sitting here babysitting the God number of college students looking for apartments today like they're scrambling, because that's a lot of what I do. The presentation I'm going to give you today is going to provide an overview of the Mon, Marion, and Harrison County single-family real estate market. All the information was gathered from the National Association of Realtors, the Mortgage Bankers Association, and the North Central West Virginia Real Estate Information Network, which is the regional multiple listings network that serves this area. West Virginia has been the leader in home ownership for the past 3 censuses in this country. In the last census, which was 2002, West Virginia had a home ownership rate of 75.2%, while the nation as a whole was only 66.2%. So it says something for the fact of West Virginia that we do believe in home ownership. This slide here just gives you some information on mortgages as presented about West Virginia, as well as some about the economy. The national economy and home mortgages indicators, where there was 30% of the homes that were owned had no mortgages, whereas West Virginia, 51% of the homes in 2007 did not have a mortgage. Prime mortgage financing, this is of the loans that were made, subprime financing, and FHA or VA financing. So it goes to show that West Virginians tend to be more into prime financing, less in the subprime markets, which is quite a benefit from what we just went through. Foreclosures in 2007 figures, these are just based on the number of mortgages that were written that went into foreclosure. Of those mortgages that went into foreclosure, 50% of them were prime mortgage financing. They don't make a distinction with that when they give that and tell you why they went into foreclosure. It could have been a job loss, it could have been for health reasons, it could have been for a divorce. They just equate it to what the mortgage was. The overall rate in 2007 for West Virginia was only 1.4% of all mortgages written in 2007 went into foreclosure, which is significantly lower than the national average. Real estate in West Virginia has an economic impact on the gross state product of 12.8%. It has a tremendous effect on the state of West Virginia. The economic contributors are derived from the following areas. And other related activities on this slide would be your pest inspection, your home inspector, and those people that are involved with those activities. The median home price in 2007 for West Virginia was $165, Marion County was $90, Harrison County was $109.9, Mon County was $167, and the 14-county region of the MLS was $124.4. In 1995, 4 boards, Morgantown, Fairmont, Harrison County, and West Buchanan, created this MLS because we needed a better vehicle to work with the public. We cover 12 counties in West Virginia and 2 counties in Pennsylvania. Some just quick definitions. We call single-family home can be broken into 2 parts, attached and detached. Attached is your duplex, your condo, your townhouse. Detached is the house that sits here by itself and there's nothing else hooked to it. Days on market is from the time the property is listed till the deed transfers, and percent of list to price received or percent list to sell is what was actually received for the property, a percentage of what was actually asked. This slide here just gives you some information on some of the things that's happened in the past. As you can see, if you look from 2004 to 2008, we had increases. This is Marion County, and they went down. You got Harrison County the same way, Mon County, and the whole region as a whole. You can also notice that if you look at these figures, the detached houses in both Marion and Harrison County are the bulk of the sales, and then when you get to Mon County, you see the attached houses are starting to make and now make up a tremendous portion of what is actually sold in this area. This is just for the first quarter of each year as compared. We had the first quarter of 2009, and this coincides nationally. If you look at the first quarter 2008 to the first quarter 2009, you see a significant decrease in the number of units sold. Days on market goes to the same thing. Number of units sold, we're seeing longer days on market. Mon County has taken 126 days to sell a house. We're back in 2004, houses were selling in 63 days. So it makes a huge difference as to what we do. Days on market for the first quarter, you'll see some change in there, but the first quarter is just 1 year compared to the other year to give you an idea where it's going. The average selling price. This is the interesting thing. When you look at average selling price, you can see where the average and the mean all the way down, each one of where we're at in 2008. In Harrison County, from the period 2004 to 2008, prices increased $28,407 in that period, which is 26.9%. In Marion County, it was a $35,000 increase, which is 40.2%. Montague County was a 31.5 increase, which was 18.9%. And as a region, we had a 25.2% increase. There are little blips in there. You can see that in 2006, Mon County actually dropped, but in 2007, they went back up. For some reason, there was a blip, it went down, and it came back up. For the first quarter, you'll see the same thing. On those, you'll see the same differences as you go through these slides. The one interesting thing is that the average selling price has increased every year. It's increased again this year. We have appreciation in Mon County. We have appreciation in the region, which is quite interesting. Even though we're selling, yes, units, the value of these units is gradually increasing. The list to sell is what a prospective buyer actually gets when they sell the property. As you can see, we had highs and lows. Right now, first quarter, it's gradually slipped a little bit, but when you go back and look at traditionally, first quarter does slip a little bit. It's the colder months. This is the one slide that will probably really shock a lot of people. Market saturation is basically the number of active listings that are presently on the market divided by the number of sold listings in a 30-day period, which will give you the month's supply. And right now, these are the active listings that we have on these markets. And look at the ones that are detached, the ones that are attached, and the total. You know, in Mon County, we have almost the same amount of attached as we have detached. One of the primary reasons for that is the cost of land. Cost of land in this county is significantly higher than it is in the other two counties. Now, I will tell you that these three counties make up 75 to 80% of the total real estate sold through the multiple listing service in this 12-county region. So you can see right here, Morgantown has a huge, call it glut if you want, of attached. Month supply, inventory it's on hand. Right now, this is what you have in a detached house in all three counties. Fairly uniform. You come over here and look at the attached, you can see what Mon County has right now. 15% months of townhouses, duplexes, condos presently on the market. And you can see the combined if you combine them. So if you want to talk about, yes, housing has slowed down in this county some. Second quarter looks a lot better. Just in quick summary then, the number of units has declined, which means the average price has increased. We're having appreciation in home values even though we're selling less homes. In Montague County, the attached homes account for 30% of the units sold, and right now they're 45% of what's available to purchase. These are higher land costs compared to our neighboring counties. It makes a significant difference. Detached homes, when you build your detached home, the average price is $2,000 or higher. People building the attached homes, the townhouses and duplexes, the average starting price is around 140. So it's a significant price for people. Days on the market is increasing. That indicates, again, a slowing real estate market. The housing inventory is an effect of the national economy. We do have a ripple-down effect. With the national economy slowing, yes, we do have a ripple-down effect. The national news media and their continued doom and gloom does not help what we do, because they come out, everybody sees the national part, they don't look at the local part. We may be positive where the national part is not as positive. Some of the positives that come out and help us: the new first-time homebuyer program, the tax credit of up to $8,000 with no cap on the purchase price. Interest rates are low, the best we've ever seen in years. I will have to commend the lending institutions in this region. They did not jump into the subprime market like a lot of people did. That is a very positive effect. We're not tied into the federal government stimulus package with a bunch of restrictions. Overall, we're poised to meet the demands of the public right now in this region. The average price of a detached home in Marion County, well, it's not the average price. In Marion County, you can find homes priced at $11,900 to as much as $599,000. So there's a wide spread in Marion County. Harrison County goes from $11,900 to $2 million. And Mon County goes from $40,000 to $1.8 million. We won't talk about the $1.8 million house. We all know who that one belongs to. Even though we're likely to see reductions in units sold in 2009, our home values are going to continue to increase. Void of any major employer reducing their workforce or closing, 2010 will be a better year than 2009. Our national economy is getting better, and things are moving forward. One of the instructors I had in real estate one time always says, look at the glass as half full. Never look at it as half empty. And when someone asks you how real estate is, just reply with one word: it's unbelievable.
Thank you, Bill. We'll hold any questions from the audience until our third panelist is finished. The second speaker is Brian Thomas, who's president of Clear Mountain Bank. Brian?
Well, good morning, and thank you for the opportunity to come and speak with you here this morning. First, I want to start off with, I found this is from 1980, and I think it holds true today. This was a recessionary period. The government said, if it moves, tax it. If it still moves, regulate it. And if it stops moving, stimulate it. And I think that seems appropriate today. Banks are highly taxed or highly regulated, and you've heard ad nauseum about the stimulus for banks. But this is from Ronald Reagan, and I think it still applies today. Let me tell you just a little bit about Clear Mountain Bank so that you know sort of the background that I'm coming from this morning as I talk to you about our perspective from a community banker on the local economy. We're headquartered in Brewston Mills. We're over 100 years old, so we've been through world wars and depressions. We've seen some ups and downs. We have 11 locations. 10 of our 11 locations are in the Morgantown MSA. We have 5 in Monongalia County, 5 in Preston County, and we have 1 in neighboring Garrett County, Maryland. We have 145 employees, and we currently manage $352 million in assets. Contrary to maybe part of the national trend that you see the talking heads talk about, we are well capitalized, significantly above. We still have a CRA rating of outstanding, and we still have a 5-star Bauer rating out of 5, and we didn't receive any TARP funding. Now, the reason I point that out is not to toot my horn, but rather to tell you that you can't believe everything you see on the national news media that all banks are having problems, because locally here in West Virginia and more locally here in Morgantown, I think you'll find that banks are doing rather well. So we're not all painted with the same brush. I'm here to tell you that community banking is alive and it's well. Basically, it's perhaps the only sector in commercial banking that's really doing reasonably well right now. Again, when they say banks are doing poorly, banks are not lending, I hate it when they use the term banks because it's too broad. You have to really think about the segments of the banking industry. We are not investment bankers. We are not mortgage bankers. We're community bankers here locally, and things are going pretty well. So far in 2009, 55% of community banks are reporting that they're increasing their deposit basis. Only 17% are showing a decrease, so that tells you that community banks are growing on that side of the balance sheet. And you hear about all the woes about lending. Banks aren't lending. Well, for the first 2 months of the year, 40% of community banks have increased their loans outstanding, and only 1% of those banks, community banks, have shown a curtailment in their lending activity. So again, banks are lending, and that's one of my strong messages this morning. And the reason I think that community banks are doing well, despite all the bad news you hear, is that most community banks are well capitalized and have avoided the problems that have contributed to the demise of some of our larger brethren. So again, don't paint us all with the same brush. To tell you how the trend is working locally, again, I told you 10 out of our 11 offices are in the Morgantown MSA. In 2008, our deposits at Clear Mountain increased 12.4%, and our loans increased 14.5%. Now, what about the first quarter of 2009? Deposits are increasing at an annual rate of 23.6%, and our loans are increasing at an annualized rate of 5.4%. The area is growing, and banks, at least we're one example of the many banks in this area that are still making loans into the community. And we're still profitable, thank goodness, or else I probably wouldn't be here talking with you this morning. Or I would have taken my bonus and jettisoned off someplace. And capital remains pretty strong. Capital's king right now. In banking, capital is king. If you're not well capitalized, you're not able to take advantage of the opportunities that are presenting themselves. And I would tell you that many of our competitors are experiencing similar growth in loans and in deposits. And again, the local banking sector is, for the most part, very healthy and robust. Let's talk about deposit growth. Some of those numbers may surprise you. Why are deposits growing so rapidly? First, I would say that we're experiencing what I call a flight to safety and quality. You know, equity-based investments have lost 40% or more of their value from their peak. It's rattled people. So banks and deposits, you know, we offer no risk of a principal loss. And even if the bank were to fail, the FDIC backs that deposit up to $250,000. So it's a very safe place. A lot of consumers, a lot of businesses are going to that safe place to put their money, and that's why you're seeing banks increasing so rapidly with their deposits. You're also seeing households. They're not borrowing as much. They're not spending. They're saving, which I think is a positive thing for our economy. So healthy and well-capitalized banks can gain from these trends. The only question that we are asking ourselves is, will these deposits stay for the long term? Once the stock market starts to increase again, will those dollars leave the bank and follow the stock market for the higher return? And I don't have an answer to that question. I will tell you that in terms of loan growth, loans are growing. That growth has slowed significantly. And I would tell you it's not because banks aren't willing to lend. I would tell you because there's a lack of demand. People just aren't spending money. Consumers and businesses, I find, are postponing that purchase. They're afraid they might find it cheaper next week. They're afraid that they might lose their job. They're just not as willing to pull the trigger. The housing market, we've found, has slowed locally. Again, those are big loan purchases. Those are slowing, so that's not happening. We are experiencing fixed mortgage rates at all-time historic lows, and what that's been doing is there's a home refinancing boom going on. Our refinancing pipelines are huge, but they're refinances of existing mortgages. I would tell you most of the mortgages that we are processing right now are refis, and a lot fewer of them are new home purchases. A lot of people who have adjustable mortgages are refinancing those into fixed-rate mortgages, and Banks sell their fixed-rate mortgages off into a secondary market because we don't like to retain that long-term interest rate risk. That's another reason you see loans perhaps not growing on bank balance sheets as much, because these refinance loans that are being sold are coming off bank balance sheets and being sold to other investors. I would tell you that there's a change in lending attitudes. The talking heads say that banks aren't lending, and I'm going to tell you that it's simply not true. They say that loan standards have tightened. That is true, but I tend to think of it more of we have returned to some sense of normalcy. We're getting back to the basics. We have stopped as an industry this phenomenon of loaning somebody $1 million for a house when they only make $25,000 a year in income. It made no sense. So have we tightened from that? Yes, but I think we're returning to some common sense as opposed to real, adverse tightening. Consumers are sitting on the sidelines. I've already talked about that. They're saving rather than spending. Loan demand is down. The secondary market, the people who buy these fixed-rate mortgages, we have to follow their guidelines. They've tightened them significantly. So, yes, new people buying a new home will find that the guidelines are tighter. Credit score requirements are higher. Yes, you actually have to have a down payment now. Shudder the thought. But that's what we're into now. So, and we're going to find that home buyers that lack an adequate down payment are going to have a more difficult time getting into a house. 40% of new home buyers lack an adequate down payment to get into that first house. That's a problem that we're going to have to address because it's going to keep people out. I'm going to talk about TARP. This is the thing our customers are talking about a lot. I'm here to tell you that I think, this is just my personal opinion, TARP is a failure. TARP, from the federal government's perspective, does nothing, in my opinion, to spur demand for loans. We can hold a gun to someone's head, but we can't force them to lend or borrow. So TARP did nothing for borrowers. It does nothing for loan guidelines that are tightening. Again, we're returning to normalcy, which means loan requirements are tightening. TARP didn't address that. It doesn't address borrowers who need assistance with that first down payment. We found it to be expensive. It's 5 to 10-year funding, so it's not permanent. So as a banker, you look and say, okay, we'll take the money now. Uh-oh, in 5 years, we've got to find a way to repay that money because it's not permanent capital. We think it invites government meddling. Now, I know some of you are with the government, and we love you, but we just don't want you in our business more than you have to be. And it carried a stigma, okay? I don't think TARP was bad. I don't think TARP is bad, but in the minds of the public, it's very distasteful, and so that was another reason. So, and I guess our mantra is let the free market prevail. Get out of our business. Community bank success. I would tell you that most community banks are well capitalized. Capital provides you with that cushion to weather the storm. And money center banks, which are what you hear most of the news about, they carry far less capital than a community bank does. The thought being they're not required to have as much capital because they're more intelligent, they're more sophisticated, they have more resources. Well, I think we found that, again, that may not be true. Of course, I'm unbiased as a community banker, but that's just my unbiased opinion. Most of us stayed with the basics of lending. Okay, we didn't get into the fads of subprime. We didn't get into the neighbor syndrome. Well, this bank's doing it, therefore that must mean it's okay for us to do it. We stuck to the knitting, and as a result, I think we're enjoying the benefits of that. We have much simpler balance sheets. We don't have derivatives or assets and liabilities that are hard to value. Again, loans, deposits, pretty basic things. And I think we're closer to our communities. We're able to know what's going on locally. We're here. We live here. We work here. We go to school here. Citicorp, nothing against Citicorp, but they're headquartered in Manhattan. I don't think they know much about what's going on in Morgantown, West Virginia. But I would think that your community banker does, and that gives us a little bit of an edge locally. The other thing I like about community banking is it has a long-term focus. We're making decisions for the long-term health of the bank. We are not managing for a short-term stock price or to make a great next quarterly earnings report. That's just not what community banks are doing. The other thing I would tell you is that there's no bailout for community banks. We're not too big to fail. If we make mistakes and we fail, guess what the government's going to let happen to us? They're going to let us fail. They're not going to come and bail us out, so we can't take the risks that some of our larger friends can. So in our opinion, my opinion, we need to prevent the large banking organizations from getting bigger and creating more of a problem of these banks that are too big to fail, because it really does invite a lot of excessive risk-taking, unmanageable levels of complexity, and too many interdependencies that when one falls, you have this domino effect that may occur afterwards. Now, I think that the next problem area for banking, and I don't think that we're going to be immune from this locally, is going to be in commercial real estate loans. That's the next potential problem. When consumers are spending lower amounts of money, it is hammering the demand for retail and office space. We're seeing values dropping in many areas of the country. Defaults are increasing in commercial real estate. And as a result, banking regulators are focusing heavily on the commercial real estate lending activities of the banks that they oversee. If you go back to 1993, commercial real estate loans represented 156% of the average bank's capital. Last year, or no, I'm sorry, in 2006, excuse me, they represented 318% of the capital. We have a larger concentration in commercial real estate loans. So has that gotten the attention of the regulators? Absolutely. So what they did back in 2006 is they established this threshold. They said if your bank gets over the point to where your real estate loans, your commercial real estate loans, are equal to or more than 300% of your capital, we're going to keep an eye on you. And I love their language. They say that they suggest that banks at that target, quote, employ risk management techniques and capital levels as they approach or exceed it, which basically means we've got our eyes on you, you better slow down. So I would tell you that banks who are at that level or above, you're going to find that tightening standards, and half of the banks in our MSA are at or greater than the 300% level. So I think that you're going to find some banks, not all banks, but some of the banks are going to tighten up on their real estate lending activities because the regulators are going to be tightening down on them. It's just a fact of what's going to happen. Regulatory pressures. As you can imagine, with all the bad news, there is a significant amount of pressure being borne on regulators to make sure that bank failures are prevented and problems are avoided. So more stringent bank examinations are taking place. In the first quarter of this year, 61% of community banks recently examined said their examination was significantly tougher than their previous exam. We're examined once every 12 to 18 months, depending on your size and complexity. So this means what? This means tougher loan regulations and tighter loan requirements going forth. The problem I find is that they're taking a big bank approach to community banks. They're more complex, we're not, but we're all treated very similarly. So you're going to find that the impact will be stricter lending standards and higher capital requirements for banks overall. Now, in terms of the local economy, I would tell you that we're very fortunate to be in Morgantown. Obviously, you've heard unemployment rates are low, real estate values are stable, the local economic base is solid. Of course, we have the university, we have the health care, we have federal government jobs, and we have natural resources. But I would tell you, I'm not going to pat our bank on the back. I'm just going to tell you simply, we're in the right place at the right time. We could have just as easily been in Detroit as Morgantown, West Virginia. So I'm not going to tell you that we've done anything magical as a bank. But to tell you how good things are in Morgantown for banks, from 2000 to 2009 in the Morgantown MSA, the population increased 7.2%. The number of banking and credit union offices increased 34%. So the number of competitors out here looking for that business has grown 5 times faster than the population. So I would tell you there's no shortage of banking competition in the marketplace. So it's a great place to be a consumer of financial services as well. Are we recession-proof? I've heard this term thrown around a lot. And I'm here to tell you as a banker, no. I hate that term. I think it's a dangerous term. We are not recession-proof. We have grown, and it's been robust, and it's been long-term. But it's been so good that many of us have forgotten the last time the markets did go down, and we get into maybe a pattern of complacency. I think recession-resistant is a better characterization because we are not without risk. In fact, I went back and there was a publication in Detroit that said that, this is from the 1940s, that they were recession-proof at that point in time. And I bet they thought that they were. So it reminds me that we are not immune. Before this recession, some reports stated that our government was able to manage the economy so well that we would not have recessions in the future. And then, boom, we're into this one. So I'm telling you that from my perspective as a banker, it can happen in Morgantown, and we're always looking to that. Bankers may tend to look at the dark side. I'm going to tell you where we see the potential risks and concerns as we manage our bank for the long term. Here are the risks to our market area. First of all, if our college enrollments decline, it's going to hurt our economy. So we're always watching that. When will that peak out? Well, when will it fall? What will the promised scholarship do if they cut that? What will that happen to the local economy? So we need to protect that. What will changes in government spending do? Obviously, they're increasing spending, but if the deficits increase, government may have to either increase taxes or cut their spending. How will that impact us down the road? What will national health care policy do to Morgantown? We're heavily dependent upon the medical care industry. It could have adverse effects. Medicare, predicted to go bankrupt. Changes in that. What will happen? We have an older population here. A lot of our hospitals and providers of care depend on that Medicare payment. What happens if a major employer leaves? It could happen. Where would we be then? Fluctuating energy prices, we've heard talk about that. I'm concerned about the lack of highway infrastructure. It's going to impede our growth at some point down the road. We have to invest in that, or otherwise I think it will have an adverse impact. As a banker, I'm concerned about the lack of planning in Monongalia County, not the city of Morgantown, but outside the city limits, because right now you don't have to have a permit to build outside the city. There's a lot of activity outside the city. There's no way to measure the supply. We can measure the demand, but we can't measure the supply because we can't measure building permits. We can't control the quality of what's being built. So as a banker, I would tell you I'm concerned. I'm not in favor of zoning in the strict sense of the word, but we do need to have some way of regulating and planning a little bit better. And as a banker, I am concerned about the number of multifamily units on the market. You've heard that a couple times. Townhouses and condominiums, there are a lot of them. And I'm seeing that several of them that aren't being sold are now being leased, which is an indication that there's just not demand for those units the way we had hoped. So in conclusion, I would tell you most community banks are financially strong and growing locally. We are lending. Don't be afraid to go to your bank and ask for a loan. If someone says banks aren't lending, it's just not true. You will find that the lending guidelines are tightening. We're going to make sure that people are qualified to make that payment before we actually extend them that loan. We're going to find that the banks that stick to the basics of prudent lending and capital management are the ones that are going to thrive. We can't be complacent. We can't rely on the belief that our market is recession-proof, and I think we as a community have to continue to proactively plan for the future to prevent problems from occurring. We don't see any or foresee any problems with local banks that we're seeing with the national banks. I think our banking community is very healthy. And with that, just thank you again for the opportunity to be able to share some of our thoughts this morning.
Thank you, Brian. Our last speaker is Terry Cutright. Terry has served as the Executive Director of Main Street, Morgantown. Terry?
it's always interesting to go last. And I was in banking for 7 years, and as Brian was speaking, which very respected banker in the community, I thought, man, that's why I got out of banking. That's just like too serious for me today. So I guess that's why I got into Main Street. And as Mr. Burton mentioned, that the national media is very much doom and gloom, and I hear it every day, you hear it every day, but in Main Street, the only positive thing from that is 20 years of Main Street, I have never heard the words Main Street mentioned as much on the nightly news. So at least we are getting a little attention. For the last 25, 30 years, all we've heard about are malls, so it is nice to hear the words Main Street and the focus on a lot of our small businesses that are located in our downtowns, which are primarily mom and pop, locally owned businesses rather than chains or franchises. Some of the information that I have for you today is, and I definitely am going to relate it back to downtown Morgantown and also the Wharf District, which are our areas of service. But most of this information I have either gathered on my own through limited reading time. If you're like me, you spend a better part of your day with your required reading. And also, my national meeting was early this year, and it was in March, and it was in Chicago. And the first week in March in Chicago is an interesting week to be in Chicago. But probably a lot of this information, and I guess I'd like to see a show of hands of how many people will admit in a group like this that you have a Facebook page. Okay. Well, my advice to you is find somebody in your professional world that is smarter than you, has more time than you, and become their friend. Because I have become friends with several national and international downtown revitalization experts, and one of those is Kennedy Smith, which if you don't recognize that name, in our world, she is international. She was the director of the National Main Street Center for over 20 years. She is probably the most successful downtown revitalization consultant. Definitely in the United States, if not the world. And Kennedy is my friend on Facebook. And every day she posts several articles and sends you right to the link. And I wrote her last week and I said, Kennedy, how do you do it? What am I doing wrong here? You're highly successful business-wise, so I know you're busy. You have a fabulous social life. How do you keep up with all this? Are you a speed reader or what? Because I can hardly keep up with the things that I need to read. And I said, I'm the grasshopper, teach me. And she said, yes. Matter of fact, when I was in the 9th grade, a teacher offered an after-school program to speed read, and out of her high school, only 2 people participated in that, and that was Kennedy and her friend. So some of this information does come from being Kennedy Smith's Facebook friend. One current trend that is going on, and a lot of these are, you can relate to them from a downtown perspective, but some of them not necessarily apply to that. There is very much a trend going on right now with upscale restaurants that if you're similar to I am, that you're not necessarily thinking we're going to go out and spend $100 for dinner this Saturday night. So there are a lot of upscale restaurants, whether it's an upscale restaurant in Manhattan or it's an upscale restaurant in Thomasville, Georgia, that they are turning their trend a little bit more to their bar business. They're taking over a little bit of the space within their restaurant. They're changing up their menus, lending themselves more to heavy hors d'oeuvres. Also with their drink menu, making some changes there. So you will probably start to see that shift, whether you have seen it or not. Another interesting point that came out of that article, which was in the Wall Street Journal, was that not only people are looking for different price points, but also during this economic downturn, nobody wants to sit at home and talk about their personal finances with their family or their spouse or their significant other. Sort of like the TV show Cheers, where everybody knows your name. Everybody wants to get out and be among people. You know, we have a whole lot of social networking going on in that way. So the restaurants are definitely responding to that. Another activity going on, and this is not necessarily, but a little bit more with the freestanding restaurants and some of the national chains that have failed, that there are a lot of other national chains that are looking at their sites. And if, an example, the closure of a lot of Starbucks, Panera has started to look at those locations that Starbucks closed and trying to evaluate, is that a good location? And if it is, they can save as much as 20% just to go in there and do the retro or the build out in that, as opposed to going ahead and building their own location. These national franchises or these national companies, they have to evaluate, though, did Starbucks leave that location because it was a dead location, or did they leave it just because it was not providing them with the profit margin that they were requiring as a national or as a franchise? A lot of our small businesses, particularly the retail side, trying to make shopping a little bit more of an experience, just not that, you know, here's my new spring line. It's more, here's my new spring line, and oh, by the way, we're having wine and hors d'oeuvres on Friday night, and since you're one of our special customers, come on in. Also, you know, we're offering massages, just that whole, making it an experience and just not, you know, you're coming in to shop. Also along those same lines, not only do our small businesses and our small retailers have the competition of the larger chain restaurant or chain retailers, but there's a new trend coming about that there's a few women in the room, and whether you know this is you probably definitely know somebody like that. People that love to shop, particularly a lot of women, and your closets are just jam full. Some of the times they still have the tags on them that you haven't even gotten around to it. So there is a new emerging business where women are actually turning their closets into small boutiques. You know, they've purchased a lot of designer clothes, and now they are opening up their closets. They're offering wine night and essentially turning into small boutiques within their home. Another major trend going on is everybody is essentially what they're terming as shopping down. You know, the days are gone where everybody wanted to walk around and with a Saks Fifth Avenue bag and be able to buy all those designer clothes. An example that was given in the article that I read, that there's a store called Restore, and they are operated by Habitat for Humanity, and essentially people can give their household items to Habitat for Humanity, whether it's that chandelier in the dining room that you replaced 10 years ago and it's been sitting in your garage collecting dust, and now you can give it to Habitat for Humanity. And what was a $1,200 chandelier 10 years ago, that Habitat from Humanity, I can go in today and buy that same chandelier for $50. The person that donated it to Habitat got the tax benefit of giving that item. I guess I've been on Main Street too long, that I was out at Marilla Center the other day to talk about a community art project, and I'm having a contractor do some small work for me, and he mentioned there's a store out behind Marilla Center that has some building supply equipment. You ought to check it out. There's maybe some cabinets there, and so I mentioned to the guys at Bow Park, I'm like, is there a supply store over this way? And they said, yeah, that's Restore. I go, we have got a Restore in this community. Why don't I know that? He said, you've been on Main Street too long. and I mentioned I was in Chicago for our national meeting, and a whole lot of changes going on the Miracle Mile. If you haven't been to Chicago lately, Lord and Taylor has closed, Talbot's has closed, Pottery Barn has closed. Borders was within 2 weeks of closing from when our conference was. And, you know, obviously the reasons are tourism is down in Chicago. There are not as many conferences going on. A lot of people are switching over to webinars and trying to do regional conventions and conferences. Luxury items down by 10%. Communities, from a downtown perspective, particularly, a lot of communities are creating their own currency, if you will, downtown dollars, selling them for less the value than an actual dollar, and trying to stimulate their own economy by people utilizing those. We have looked at that as an organization. We've looked at a lot of different things and tried to figure out how do we retool ourselves. And an example of this is this weekend we're having Chocolate Lovers Day in the downtown. This is our 10th year to have Chocolate Lovers. It's pretty much a subliminal special, or it's subliminal shopping, but it looks like a special event. But our goal is to get a lot of people downtown and to get a lot of people into these businesses. Won't be a big day to ring the cash register, but it'll be a day that people either discover or rediscover businesses, and they have a map and they just go all around the downtown. And one of our goals as the downtown organization to help try to support our businesses was, we said we need to have the largest participation that we have ever had. We need to send that message out that the downtown is alive and well. We have a lot of great businesses in our downtown. So I'm proud to tell you that we have 42 businesses, which is the largest participation that we've ever had in this event. And so I welcome you to come down. But that's just an example of some of the things that we're doing as an organization to try to deal with the economic downturn. We have a new event that we are creating this summer. There again, another reason to bring people back downtown. That August the 8th, we are having, it's called the Brew Ha-Ha, which is beer and comedians. I had to kind of explain that to my husband twice, so hopefully it won't take you that long. Just another reason to bring people downtown. So that's kind of on a promotional direction on what we're doing. On an economic restructuring, we have had several webinars and essentially online conferences about how to survive during this economic downturn, if not thrive. And we continue to partner, whether it's with Don Ranke and his group, or it's the Chamber, or it's the CVB, inviting all their constituents to come and be able to learn from this, because we identify not only does the downtown have to be strong, but the entire community has to be strong. We continue as an organization to look towards the future, that you know, as you step outside, you see this hotel conference center coming online. We've been talking about it. We've been excited about it. Those are all people that we want to visit the Main Street district, whether it be the Historic Wharf district or it be the downtown when they come. So in order to gear up for that, we just completed a hospitality assessment, looking at ways to have a safer, cleaner downtown, being able to attract that conference attendee and the people that'll be either coming to this property or we'll be staying at the Hotel Morgan. So those are all things that we continue to look towards the future. We're in process also of updating our kiosks, our business directories, and just basically doing anything that we can do as a support organization to help that business with their bottom line. I continue to have very small, but do have some continued business interest. I told you earlier, Kennedy Smith was my friend. Well, she has gathered information from me by being, I'm her friend. She wrote back that I had used my Facebook space to, or my page, to write that we have 2 new restaurants opening in downtown Morgantown. Dragonfly, which opened this last Friday on Chestnut Street, and Mother of India restaurant, which is hoping to open by Mother's Day. And she wrote back, you know, fabulous for Morgantown that you're able to open 2 restaurants during this recession. So, and I have a few retail interests out there, but we're redoing our recruitment materials so that when the time does come, we're ready to go with our materials. Thank you.
We have time for a couple questions from the audience to any of our 3 speakers. Are there any questions? Chance of a lifetime. Okay. Yes, sir.
This is a question for Brian. We've seen quite a number of credit unions move into the area and to expand. And I know that they're not taxed, and they're looking for tax money. As a community bank that is taxed, what's your take on the expansion of credit unions, the liberalization of the membership rules in that area? Is it a bone of contention with community bankers?
Well, I'm unbiased in my opinion, so keep that in mind. Yes, credit union expansion is a huge concern for community bankers because we believe that because they are not taxed, I mean, each of you in this room paid more in personal income tax last year than all the credit unions put together in the United States. Now think about that for a minute. And because of that, they're able to offer sometimes rates that community banks, commercial banks, aren't competitive with. And credit unions, I think, have a time and a place, but I think that when they start to look like banks and walk like banks and talk like banks, then they're banks, and they probably should be taxed. Again, bankers have fought that, but it's a very unpopular issue for Congress to tackle because credit unions are incredibly popular amongst the consuming public, so a lot of them don't want to touch it. The other thing about credit unions that I would tell you is that they are definitely not as highly regulated as banking is. We undergo a series of very stringent examinations. We have audit examinations, computer system examinations. I mean, we have examinations for examinations. And I'm not exaggerating that either. But credit unions don't have to undergo that kind of scrutiny. And so one of the quiet things you don't hear much about is how are the credit unions faring through this economic crisis? And I think the jury's still out, but yes, it is definitely a bone of contention, and I think that we ought to tax the credit unions that are becoming like banks.
I think I'll turn the podium over to our Dean of the College of Business and Economics, who will be able to answer that question and also make some closing remarks. Good segue.
Well, to answer your question about enrollment, the goal at WVU was to get to 28.5, and we got there, and they don't intend to grow beyond that. In terms of the upcoming fall enrollments, picture's looking pretty good. The applications are up. And the quality of the applications is up as well. Particularly, I think average ACT scores are up like 2 points, which is pretty darn good. What is down is deposits, which is worrying the administration somewhat. You can understand that people are holding off. They're waiting to see what happens, but we remain hopeful. The problem with, for WVU is that 10 students can make a big difference in terms of our overall budget, because state support is a very small proportion of the overall budget in higher education today. We really, really do depend on that revenue. Well, thank you very much, Tom. I want to congratulate you for yet one more very, very successful Economic Outlook conference. The College of Business and Economics remains committed to economic development in the state by providing the information and the analysis like you saw here today. And I want to congratulate our analysts for providing really fascinating outlook for the nation and the state and Morgantown in particular. I would make the comment that if there is a silver lining in all this doom and gloom with the economic crisis, it's that it's really put Morgantown, West Virginia on the map. We are doing really, really well, and we're getting a lot of attention for it. I want to thank our underwriters listed on the back of the summary of the Morgantown Economic Outlook Conference. I hope you will remember them fondly. I want to mention a couple of upcoming events, speaking of our commitment to economic development. One is the final round of the statewide business plan competition, which will be held this Saturday at 9 o'clock at Ming-Shea Hall in the downtown campus. And the second is our corporate responsibility class, which you may have heard of. On May 1st, it will be dispersing $20,000 to local charities and nonprofit agencies as part of that course. We value your feedback, and you will find in your packet a form which we would appreciate your filling out and handing in at the registration desk. Once again, thank you very much. Have a great day.